Good morning. Thank you all for participating in this inaugural public hearing of the CSBS Emerging Payments Task Force. My name is David Cotney, and I'm the Massachusetts Commissioner of Banks. I also serve as chairman of the CSBS Emerging Payments Task Force. Joining me today are my fellow members of the Emerging Payments Task Force. Starting to my far right, Drew Breakspear, Commissioner, the Florida Office of Financial Regulation; Kevin Hagler, Commissioner, Georgia Department of Banking and Finance; Manny Flores, Acting Secretary of the Illinois Department of Financial and Professional Regulation, and our host today at our hearing here in Chicago; Dana Syracuse, Associate General Counsel, the New York State Department of Financial Services; Greg Gonzalez, Commissioner at the Tennessee Department of Financial Institutions; Charles Cooper, Commissioner at the Texas Department of Banking; Ed Leary, Commissioner at the Utah Department of Financial Institutions; and Scott Jarvis, Director of the Washington Department of Financial Institutions. And I also want to acknowledge my fellow state regulators who are in attendance here today. First, let me start with a bit of background on the Conference of State Bank Supervisors, or CSBS. CSBS is the nationwide organization of banking regulators from the 50 states and U.S. territories. For more than 100 years, CSBS has given state supervisors a national forum to coordinate supervision and develop financial policy. Put simply, CSBS is the D.C. field office of state financial regulators. State regulatory agencies charter and regulate insured depository institutions such as banks and credit unions. But most states also have jurisdiction over non-bank financial service providers as well. This includes mortgage lenders and brokers, money transmitters, payday lenders, check cashers, and finance companies. Through CSBS, state regulators coordinate supervision of these entities, discuss emerging trends in our states, and work together to address changes or developments in the financial services industry. One of the developments that caught our attention last year was the change we saw taking place in the payments systems and how this evolution was impacting banks and non-banks, the role of state supervision, consumer behavior, and financial market stability. To better address these changes, state regulators, through CSBS, formed this Emerging Payments Task Force. Our objective as a task force is to study changes in payment systems to determine the potential impact on consumers, state law, and banks and non-bank entities chartered or licensed by state regulators. We have been charged with taking a comprehensive approach to studying the changing payment systems, including virtual currencies, but I want to stress that this task force is charged with evaluating and studying payments developments beyond virtual currency. Recognizing the varied perspectives and breadth of the issues we've been asked to study, the task force believes it is critical to engage external stakeholders on these important issues. As such, this hearing is a first step to getting input from industry participants and subject matter experts to understand how new entrants and technologies affect the stability of payment systems and the broader financial marketplace. And just on a side note, while the focus of this hearing is on industry developments, our task force will schedule a hearing later this year to focus on the impact on consumers and consumer protection. As state regulators, we have many supervisory tools at our disposal, but we welcome the opportunity to explore how to adapt the existing supervisory framework to address emerging trends. Many of the changes we've seen over the past few years, such as mobile payments, peer-to-peer, and virtual currency, just to name a few, have been driven by demand from consumers, financial industry, and businesses for a better payment system, one that is more secure, more real-time, and less costly. Ultimately, we are seeking the best possible supervisory structure to encourage innovation while still maintaining safety and soundness, public confidence, and consumer protection. And this hearing is a critical component of our understanding of the state of play, and we very much appreciate everyone's attendance and participation in this inaugural public hearing on emerging payments. So before I introduce the first panel, a few housekeeping announcements. First, please silence all cell phones. This hearing is being streamed live via webcast, and a recording will be made available in the coming days. We have 3 panels today, each scheduled to last 1 hour, and will consist of brief opening statements, followed by question and answer. And I want to thank panelists in advance for keeping their opening remarks brief. Following each panel, there will be a short break to give us a chance to transition, and after the third panel, time permitting, we will open up the session for comments from other attendees. The first panel will focus on legacy payment systems such as check, ACH, and debit and credit cards. Second will feature a discussion on retail payments innovations such as mobile payments. And our third and final panel will be on virtual currencies. And we are scheduled to adjourn at 1:30 Central Time. And finally, I just want to take a moment to thank CSBS staff for all of their hard work in putting this public hearing together. So now it is my pleasure to introduce our first panel focusing on legacy payments systems. Our panelists this morning are Chris Daniel, partner with Paul Hastings LLP, Jane Larimer, Executive Vice President of NACHA, and Bob Steen, Chief Executive Officer of Bridge Community Bank. And again, thank you for keeping your opening remarks brief this morning. This will allow us for some good dialogue with the task force. So, Mr. Daniel, if you could please begin.
Thank you, Commissioner Cotney, and thanks to the CSBS Emerging Payments Task Force for holding this important hearing, and thanks to all of you in the room and on the web who are attending. In my very brief presentation this morning, I'm going to try to accomplish 2 things. I want to provide a larger strategic perspective on why there is such an opportunity for emerging payments and alternative or virtual currencies. I also want to educate briefly everyone on the legacy payment systems in the United States. My overview will cover a history of currency in the United States, the M1 money supply, modern payment systems, shared attributes of successful payment systems, examples, and currency and technology as a closing remark. I want to start with a quote, only because I think that oftentimes in the financial services sector, we think so much of what we've done and what we have is settled. And the truth of the matter historically is it's been anything but settled. This comes from a book entitled The Money Men, Capitalism, Democracy, and the 100 Years War Over the American Dollar. For the first 5 generations of America's independent history, from 1776 till the eve of World War I, a single question has vexed American politics and the American economy more persistently than any other. Political careers were made and broken on this question. Political parties rose and fell. Great wealth rewarded those who answered it correctly. Bankruptcy claimed those who got it wrong. No question touched more livelihoods and more lives more consistently, more intimately, more portentously. The question was the money question. In simplest form, it asked, what constitutes money in the United States? As we can see from the next slide, we've had numerous types of currencies in the United States throughout our history. We had colonial currency. Actually, the first currency in our colonies was the Spanish silver dollar. We've had colonial currencies. We've had state bank issued notes during the Wildcat period. We've had Civil War greenbacks. We've had bimetallism, gold, silver, the Gold Standard Act. We had the Bretton Woods system, which was wonderful from a gold standard. We came off Bretton Woods in 1971. So the idea of what currency actually is in the United States has been far from a settled question. Because I've always liked show and tell, here's an 1862 greenback that was issued in the Civil War to finance the Union's efforts in the Civil War. So you can tell from both the opening quote and from the continuum or timeline on the screen, currency and monetary value, again, has not always been settled. And I think we find ourselves at this point in history revisiting this question in an interesting way. The M1 money supply, of course, the statistic created and observed by the Fed, is generally a measurement of what the supply of dollars is in the system. There's an M1 money supply, there's an M2 money supply. And if you think about what dollars are, we're no longer on the gold standard, right? You can't take a $20 bill to the Atlanta Fed and exchange it for $20 in gold. We simply have a fiat currency, not exchangeable for specie. So when you think about that, and you think about the M1 money supply, which is simply the amount of money in the system, You look at the slide that's on the screen. On October 13th, 2008, around the date of the Lehman bankruptcy, we had roughly $1.4 trillion floating in the system. On April 28, 2014, we have roughly double that. That's after QE1, QE2, and QE3. So we have dollars untethered to currency. We have a doubling of the M1 money supply during the Great Recession. And I think you can start to think about the challenges our Federal Reserve has in managing our current dollars. I think, again, this opens up opportunities for emerging payment systems as well as virtual currencies. I want to hold up today's, or a page from today's Wall Street Journal to evidence the challenge that our Federal Reserve is going to have with the currency that we currently have. The top column, or the top article is, inflation picks up, stirring talk on Fed policy. Inflation picks up, the counter is moving interest rates higher, easing back or pulling out QE1, QE2, QE3. Next article, worries over global economic growth climb. What do you do if you have worries about global economic growth? You lower interest rates and you have QE4, right? You push money into the system. So when you think about the US dollar, you think about it not being specie-oriented, that is just simply, in a very real sense, a confidence game associated with a piece of paper. You look at the M1 money supply and you look at the challenges that our own Federal Reserve is going to have over the next 5 to 10 years as we recover from the Great Recession. Again, I think you can see as panelists, or as the Commission can see, the task force can see, there are opportunities here for emerging payment systems and virtual currencies. And moving forward to modern payment systems overview, which is a bit of a transition from the larger strategic thoughts in my opening slides. Payment systems are simply a means by which money moves from one side to another. A payment system ultimately has three components. It has consumers on one side, it has merchants on another, and a means by which to settle those transactions. In the United States, currently, there are 6 core payment systems: cash, the checking system, credit card and charge card systems, the debit card system, automated clearinghouse, and the wire transfer system. Those 6 payment systems are utilized for the following 6 types of payments: point of sale, remote commerce, bill payment, person-to-person payments, business-to-business payments, and income payments like payroll credits, or the distribution of ACH credits for payroll payments. So again, if you think about transitioning from larger thoughts about our currency and historically how it has ebbed and flowed and the opportunity we currently have for new payment products to a modern payment systems overview, you see we have 6 existing legacy payment systems, and we have 6 types of payments that are usually made. Those payment systems above, the 6, are legacy payment systems. They're what exist currently in the United States, and in many respects, those based on technologies developed in the 50s, 60s, and 70s, although they are, of course, innovating over time. But by and large, those are the legacy payment systems that we utilize. And I think there's an opportunity where technologists would say there's an opportunity because of the legacy payment systems and of our current currency situation in the United States for emerging payment products and virtual currencies. To go to the next slide, but for cash, the final 5 payment systems that were on the slide before operate in this manner. I would colloquially refer to this as either a circle of trust or a wagon wheel. And what I mean by that is for the 5 other payment systems, legacy payment systems, but for cash, we tend to have banks on the periphery that operate as the touch points for the customers and the merchants, and then you have some sort of central clearing mechanism. So if you talk about the check clearing system in the United States, you would put the Federal Reserve in the middle and all of the banks at the periphery. If you talk about the card associations like Visa and MasterCard, you would put them at the middle and you put their bank members or bank FI clients on the periphery. Again, I think a wagon wheel analogy is very helpful. And then you have the merchants and customers outside of that. Again, that's how the legacy payment systems currently work other than cash in the United States. The 4-party card network, This is an example of that transaction. You have issuing banks to cardholders, acquiring banks to merchants. You have the card associations in the middle, and you've got data flowing up at the initial part of the transaction. You've got cash flowing back to the merchant. Again, you're having the settlement system in the middle and the banks on the periphery. In this slide, which is pulled from the Federal Reserve Payment Study, the important points here is that non-cash payments continue to increase and the use of checks have fallen dramatically, and that trend line will continue. With shared attributes of successful payment systems, I'll leave this for the task force, but these are the 7 that were highlighted in a book titled The Payment System in a Market Economy: Price Stability, Thoughtful Design with respect to the nation's monetary regime, Technical Efficiency, Design with Access to Credit in Mind, Legal Framework, Official Oversight and Supervision, Central Bank serving as a final settlement authority. I would add principally the first point, which is trust. Every settlement system has to have a high degree of trust, and I think that trust oftentimes comes from not only credit and liquidity assurances, but from regulation of both the settlement system and the end participants. And I think that's where, of course, state banking departments and federal banking agencies play a remarkably important role. I'll spend just a second on this slide, and that is, I know that we think that so much of what we do in financial services is settled, that the US dollar is settled, but I will take everyone back to 1999, and that is the beginning of the euro. The euro didn't exist in 1998. It became one of the world's currencies in 1999. And I would also point out special drawing rights, which are issued by the IMF, which help the world's central banks settle balance of payments issues. There are examples currently about novel payment mechanisms or novel currencies being utilized, which are being utilized on a global basis that, quite frankly, didn't exist very long ago. I'm going to leave with this slide, Commissioner, and that is, so much of our challenge in the United States and in the world from a payments perspective is tied to this slide. While payments are global, inherently sovereign currencies are local and regulation is inherently local. So what we have as we think about payment systems generally is an interoperability problem. We as a world, from a payments perspective, operate as islands. If I want to do a transaction with Europe, right, I've got to go from dollars to euros. If I want to do it with Great Britain, it's dollars to pounds. And we have legacy payment systems which are inherently tied within the country, each country. Mark Andreessen of Netscape fame and Andreessen Horowitz fame has a saying that he oftentimes employs: software eats blank, technology eats blank. You can see what's happened to the newspaper industry, you can see what's happened to the music industry, what's currently happening to the television industry, and if you think about fiat currencies and you think about legacy payment systems, I think you can see the opportunity for emerging payment systems and virtual currencies, because I think technology is going to focus, or the technologists are going to, and entrepreneurs are going to focus on what is otherwise legacy payment systems and fiat currencies in a way that's going to lead a lot of innovation going forward. So I think, from my perspective as outside counsel to many very talented clients in this industry, going forward, this is our challenge. We're going to have to solve the island problem. And there are a lot of companies, a lot of private equity firms, and a lot of venture capital firms that are very much focused on solving this problem, which I think then ties to the regulation and how you guys are going to have to innovate both at the state level and the federal level in a way that probably is inherently challenging but will be remarkably rewarding. So with that, I'll turn it over to Jane.
Thank you, Mr. Daniel. Ms. Larimer.
Thank you. Thank you, Commissioner Cotney, and thank you to all the commissioners here today and to CSBS for having me. I'm Jane Larimer. I'm EVP of ACH Network Administration at NACHA. And today I want to cover 3 areas briefly. One is a background briefly of NACHA, who NACHA is. I know a lot of folks probably haven't heard of us in the ACH network. Talk about the ACH roadmap for future innovation, and talk about briefly the tension between increased regulation and the tension to innovate at the same time on financial institutions and the pressures that that causes. And I guess I'll forward this slide at this point. NACHA is a nonprofit association. We are the governing body of the ACH network. We are responsible for the rules, risk, system of fines, network development, new applications on the ACH network. The NACHA operating rules are the operating rules that are agreed to by the ACH operators, and then the ACH operators, by contract, push those rules down to every financial institution in the country that uses the ACH network. So the NACHA operating rules creates certainty between all the financial institutions in the country when they use the ACH network. We like to think, when you think of the ACH network, we're a little bit different than some of the other electronic payments networks. So say the card networks, they run both the switch, they switch physically the transactions, and they write the rules. At NACHA, we write the rules and we administer it, and we work in partnership with the ACH operators. That would be the Retail Payments Office of the Atlanta Fed and the clearinghouse, it's the EPN, the Electronic Payments Network. They physically switch the transactions. NACHA does not switch any transactions. We are the logical network, they are the physical network. So I wanted to talk a little bit about what the ACH network does. I think we are the electronic payment system, and now we're the legacy electronic payment system. Only 40 years old, and we've become legacy. The legacy payment system, but folks aren't familiar sometimes with the ACH network and what we do. I think everybody knows the direct deposit. So that's when I had to give my elevator speech about what I do. We bring you direct deposit. But the ACH network was originally built in the late 60s and 70s, the Department of Defense, looking for an electronic alternatives to checks. Back in the day, and up actually until the early 2000s, checks were actually either flown to clear and settle checks, or they were driven into parking lots and literally exchanged in bags across parking lots at the New York Fed. So it's very physical. And the Department of Defense was looking for a very efficient means to pay all of their employees who are scattered all over the United States and around the world, but at least within the United States, they thought, let's have an electronic equivalent to that. So the way the ACH was built and brought up, think electronic equivalent to check, and this was pre the big card networks. So the key mainstay of the ACH was efficiency. How do we move a lot of payments extremely efficiently? And that's how it was built up. So ACH, what happens is a financial institution collects big files of payments, multiple payments from corporates under them. So direct deposit, recurring bill payment, online bill payment, trading partner agreements, so big trading partner payments, and the federal government is the #1 user of the ACH network. So financial institutions gather these big files of payments. They send them overnight to the ACH operators. The ACH operators then clear and settle them. They route them to the receiving banks. They are settled the next morning. So ACH payments are settled overnight. They are not settled, I think a lot of times people think, well, 4 or 5 days. It's an overnight settlement. Now, financial institutions on both sides might hold availability for risk management purposes, but the settlement itself is overnight. The ACH network, because it's used for federal government payments, the ACH connects virtually every financial institution in the country. The big strength, one of the biggest strengths besides efficiency of the ACH network, is the fact that every financial institution has access to the ACH network. And I think ubiquity is one of the strongest, one of the key attributes we need to look at as we look at the payment systems of the future or innovating in the future, because closed loop systems can come up more quickly. You don't have to get 12,000 financial institutions to make a change, but it only has the value of those folks within the closed loop. It is the fact that to get to every financial institution, the value for any kind of user, if you have a large corporate who has employees in 50 states, they want to be able to hit financial institutions in all 50 states. So I think that's one of the things that, as we look at innovation, it has to be something that can be implemented by every financial institution in the country. And that's, I think, a huge opportunity, and it's also a challenge, having something that every financial institution needs to do. Lastly, just in terms of numbers and where we are as a retail payment system, so not the wire system, that wholesale payment system, but in 2013, the ACH network transferred a little under $39 trillion in value, 17.5 billion transactions, and that's through the ACH operators. That's more than 80 million transactions a day. So when you're looking at that, they are flowing into receiving financial institutions and posted through to their customers' accounts in a highly efficient format. This is just kind of looking at our timeline for the ACH. NACHA was founded in 1974, where regional clearinghouses decided to create a national rule scheme. so that they did not have to have bilateral agreements with regional clearinghouses. So NACHA, this is actually our 40th anniversary just this year. And we started, again, payroll and benefits, so that's direct deposit. But for folks, when you think of kind of the legacy payment systems, it's not that nothing has been evolving. There has been a lot of evolution in the ACH network since the 70s. We went from 2-day clearing to 1-day clearing of payments along that way. We have had B2B payments added on. We have ACH POS, so at the point of sale, you can use an ACH card. B2B with data. We started looking at electronic cross-border. We now have cross-border payments. The Fed RPO, Fed Global, runs I think the biggest of the ACH international transactions and clearing. Where we really saw volume starting to spike was back in the 2000s, before the advent of Check 21, when check conversion started. So that was the electronic clearing of paper, getting paper out of the system as early as possible, leading to big cost savings for not only financial institutions, but for their customers to really more efficiently run ACH payments than check, and actually to get returns a lot faster. Now we're looking at real-time messaging layered on top of the ACH, mobile payments, XML data within our formats. So there is a whole host of change. We haven't been stagnant. So what is the ACH blueprint? What's our roadmap for change? In 2012, we went out to a large swath of the industry stakeholders, including the Fed board, financial institutions, end users, and asked, what attributes would you like in the ACH network, looking out 10 years. So don't look at tomorrow, let's look out a little bit further, and where would you like to be? And so they brought up, in basically kind of large buckets, these are the attributes we would like to have. So part of those attributes, looking at the ACH formats, looking at credit payments, how do you start routing payments? So I can today mail a check to Chris, but if I wanted to send him an ACH credit payment, how do I get it to him without having his account number? How do I route it? So directory services are a very big deal. How do we create user enablement? How do we do more to solve the island problem, to Chris's point, with cross-border interoperability? How do we leverage the ACH network's ability to move vast quantities of remittance data? So 9,999 addenda can move through the ACH with one payment for big trading partners. And then how do we speed up clearing and settlement on the ACH? Because that's something that I think is important to all the stakeholders. One of the things that came clear, though, when we talked to everybody, you don't want to get all these new, cool, great things at the cost of losing the things that make the ACH. So you want to make sure that you don't lose ubiquity. Yeah, you might be able to do something faster with a small group, but you want to be able to enable everybody to do it. You want to make sure you still have value dating. So even though you want to have faster clearing and settlement, for some applications like payroll, you don't need to have anything faster. For a lot of payroll applications, if you have a stable employee base, then you might know, a week out or more than that, how you're going to pay your employees. And you don't want to lose either the certainty in the rule set or the efficiency. So if you make a ton of changes, if you make it more like another kind of payment system, you lose the efficiency of the payment system. So the thing that makes it a really good, inexpensive payment system for a lot of parties, you don't want to lose those attributes. So what we did is designed an architecture within the blueprint of how this could be done. The first piece of this is ACH clearing and settlement. Take the workhorse, take the ACH, the basic payment system, and start incrementally making clearing and settlement within that system faster. So that means not only for some products, say direct deposit, maybe you do want it faster for hourly payroll, right? Maybe you want to have an expedited bill pay service so I can pay you today, not tomorrow. So you want to do that. Also, the ACH is used to settle interbank for the card networks. So we're not only a kind of a payment product, if you think of a direct deposit or online bill pay, but settlement for the card networks often occurs on the ACH. So it is that backbone for interbank settlement of the other payment systems. So how do we make that incrementally better? Then how do we start adding this middle layer on with verification, account verification services, routing directories, leveraging our ability to move remittance data. And then the ultimate picture was you add on real-time messaging, a layer onto that. We have an opt-in program that does this today, Secure Vault Payments, but this could be in the payment system of the future. You have a real-time messaging capability so that I could pay Bob, he could get a message today that says the money is coming, 10 seconds after I've sent it. His bank could give him availability of the funds, and then it could clear and settle on the ACH 2 or 3 times a day. So that's the vision of how, if you have incrementally faster settlement on the basic payment system, on the ACH, you can support innovation into the future. And currently, our proposal that we have out, that we're working with the industry now, we're out talking to financial institutions, we're trying to find out the costs, we're trying to find out the opportunities, we're trying to find out how can we leverage this for innovation, and we're going out to stakeholders to see the value that they have. This is our same-day settlement proposal that we're looking at now, which is adding, by the end of a 3-phased implementation, incrementally building to 2 additional settlement windows a day for a total of 3 settlement windows, adding on funds availability requirements on ACH credits. So not only will the financial institution, when you send say a direct deposit same day, they will be required then to make that available to you quickly as an end user. So we think that these are the building blocks you need to be able to support mobile technology, real-time messaging, account validation, and all of the other innovation that we're looking at into the future. No red dot.
Thank you. Mr. Steen.
Well, thank you very much, gentlemen, and thank you for asking me. Breach Community Bank is a small bank from East Central Iowa. Our charter was granted in 1903. Days like today, I feel like I was there at the beginning. Chris gave you the, I guess I would call it the 50,000 foot view, Jane at the 10,000, and I need you to come way down to the 5'8" level. Because I want to talk about community banks, and I am a community banker, and I think it's important to our economy, it's important to our communities, and so I'm going to be unapologetically community bank today. So payments has been my thing, way too long, but it's particularly gratifying to me to see the CSBS take on this task force, because I think it's critical to the community bank. We have to maintain this connection to our customer, and that transaction account is the holy grail. So I've been involved in several organizations, so a lot of what I'm going to talk about today comes from those discussions. The lines will get blurred because I've worked with the Iowa Bankers Association task force. I've been on the Independent Community Bankers task force, and I was on the NACHA board. And so I look at this from a lot of different perspectives, but it all comes back to the same thing, that we have to have integrity in the payment system, and the community banks have to be in the game. And so what we started out doing was, can I leave your slide now?
Yes.
Okay. Am I going the wrong way?
No, you're going the right way. That's the index.
Okay. All right. So you'll see my bias at the outset. I think we have to work with what we have. We have payment rails, we have debit card, these have all been mentioned, the ACH, check, cash, et cetera. We've got to find a way to use them, because I don't think we have time to build a new rail or the consensus that we'd have to have fast enough to build the rail that we need. So I'll just say at the outset, I'll talk a little bit about the concept of building a new rail. Because I feel like I have to, but that's not where my heart is, okay? So what we started out doing is we decided we had to try to define the problem if we were going to try to figure out what the solution is. So we spent a lot of time on what we call the gaps. What's the compelling case for this need that we have? And we started at the Iowa Bankers Association level. We formed a task force. We had a lot of input from the Federal Reserve, a lot of support. But we spent many hours, many days, and trying to get to that. And then we said, okay, now we think we've defined the problem. Where do we go from here? And why? And I think it's obvious. The technology change is driving a lot of this. It's a free-for-all. Everybody's trying to get into game. And it's happening faster, the rate of change. And so I'd rather not call it defensive, but I guess maybe that's what it is. We have to stay in the game. And I've already described who it is, who at least my circle of friends are. The vision is pretty simple. I think for us to make this work, we have to create a circumstance where the we can connect the dots so that a payment can be made between two people as though they were with one bank. It was in one bank. Yeah, now, that's not easy, but that's our goal. If anybody's left off of this, and there are hundreds that are, I apologize, but I had to do this in one page. And so there's lots of players out there. A lot of them have come and gone. Some of them have a lot more traction than others. But we've got all these directories out there in existence, but they don't connect to each other. And I think that most of us, a lot of our community bank peers have person-to-person payment solutions through our vendor, but we're sort of held hostage, not intentionally on their part, but just simply because it doesn't connect to one vendor to another. And so we've got the payment models we have, the traditionals, where people are riding the rails, leveraging what they can, and we end up with hybrids. But at the end of the day, we need some rules. It needs to be inoperable. It obviously needs to be secure and private. And then we got to be able to deal with the things that go wrong. And stuff happens, stuff that we don't anticipate, and we got to be able to handle those exceptions. Again, we leverage the ICBA and the ABA and the Fed, the EFT providers. I would add that Notch has been in the discussion from the outset, and the clearinghouse is engaged. And so I think we have all the players in the industry to try to get to the right answer. We just need to come to a consensus and be able to make the investment to get to that level. Our goals is, we need this to be faster. I think everybody understands that if we don't make it faster, we're going to get left behind. And we're still trying to define faster. I don't personally believe that needs to be instant. I think it needs to be same day, or maybe even multiple times a day. But I'm not sure it needs to be instant. There are limitations on what we can do and still protect the customer. And so we're working hard at that level. And then there's always the business case issue. But I will tell you, and we were early into the Check 21 world, that was the only easy business case I've really been exposed to, and that was after I'd spent years getting ready for it. And I'm not so sure it was so affordable for others. We were early. We were a beta bank in many instances, so some of our entry-level costs were very low because vendors were looking for people like us that were willing to try things new. Instant versus reality. I think we have light years to go for a real-time payment processing. Some folks claim they're doing that. It ain't so. There's a perception of the payment being there, but it's typically happening because somebody else's float is being used. Same day or near real-time settlement, I think that's possible. We are, as a very small bank, have enabled ourselves and participating in the Fed's enhanced same-day product. We can send and we can receive same day. We just don't have very many partners on the other side of the curtain to receive and send them to us. I do think the instant messaging is important, and that goes a long way, but it doesn't move the money. And I think it's a good goal. We need to work at it. But all of this has to be based on good funds. If we're going to get this right, it has to be a good funds model. And so we'd like to believe the instant message is true. The money's there, or at least it will be there shortly. This is just to illustrate how as we add new players, welcome or not, the chain gets longer. The process to make a payment end-to-end is much more convoluted than what it seems for most of our customers. They have no idea what's really going on. Jane touched on it in her presentation, and just from the Notch side. But a lot of things happen. It's not free. We've somehow communicated to our customer base that this should be free. It's very expensive, and it's not free. The new rail discussion, Chris talked on this, Jane talked on this, so I won't spend any time with it. They've done some neat things, but they can get a handful of people in the room and make a decision. We got something like 12,000 financial institutions, endpoints, that have to get into the game, and that's really hard. This is just sort of our options. Start with do nothing, wait and see what happens. I'll focus on the one that rose to the top. That's my bias. That's why it rose to the top. We need a national directory. We need, or at least a directory of directories to connect all the ones that have already been built. But we got to get it right. And so my personal opinion is the Federal Reserve has to drive this, and I think that that view is shared largely by the results that we saw from the responses to their consultation paper. It was a compelling theme that the Fed needs to be the leader in this thing. And again, getting back to the basic connecting the dots, checks are we still have checks. They're not going to go away anytime soon, but we do need to keep moving the ball. Same day ACH, that's entirely easy or possible. It's not easy for everybody apparently, but it was easy for us. National directory I talked about, and we use the term the FedEx approach, where if there's value in moving money faster, so you choose how fast you want to move, and there's a price for that. So if we can leverage the PIN debit network, which actually has solved a lot of this for us, and it works. It's not free, but it works. And because we do want beneficiary choice in this payment flow, we want people. First they need the right to deny the receipt. It's not likely they will, but they need that right. And then where it goes, they should have some voice in that, obviously. And then the near real-time payments platform is the ultimate goal. This is just, again, one banker's view. The line gets blurred, but we need to leverage what we got, and so I believe we've defined the problem. We need to set a timeline. The Fed's 10 years is a little longer than we want, but the reality is we're 2 years into that 10 years. So we need to, and then the hard part, the really hard part, to get our community bankers to buy into this. Thank you.
Thank you very much, Mr. Steen. I'm going to go right into questions here. I'm going to start with our host, Secretary Flores.
Mr. Chairman, thank you very much. First of all, I'd like to begin by commending you for your leadership in this committee and the work that you've done on the federal level as well in raising the significance of this topic. I would also like to thank the Conference of State Bank Supervisors for choosing the great city of Chicago for selecting this place as the city to host the first field hearing on this topic. And also thank you to all of the panelists. This question would be directed to Ms. Larimar and also perhaps to Mr. Steen. A question of costs. Obviously, we're talking about a very large system, very large network, a network that's been around for a very long time. And as we look at the need for modernization, that would obviously not only include efficiency, but also security in the face of all of the cyber threats that we face. What kind of costs are we talking about? I mean, I think it's fair to say that it's going to be a lot of money, but have you tried to quantify those costs? And I'd like for you to also perhaps expound on what that means for the consumer and whether or not the consumer will have to bear some of those costs, and how will we know that the consumer is getting a fair shake for paying the extra costs associated with the system that they would want to see serve their needs and demand.
Hit all of those. With costs, we are actually right now quantifying the costs. So
If you could just pull the microphone right close to you there. Thank you.
we are fielding a survey now, trying to delve into the cost, because it's difficult, even one-on-one with financial institutions, to say this is the prospective cost, because they're trying to scope out what it's going to be. One of the things when you look at this, there's a couple different buckets of costs. The first cost would be, the operator or the switch cost to support this. So, how do you create the infrastructure or upgrade the infrastructure to support it? And generally speaking, the more that the operators or the switch bears, the fewer the costs that may move out to all the financial institutions in the country. So that's one piece of it. The second one is in the United States, as opposed to the other geographies, most of the other geographies that have gone to a faster payments. With 12,000 financial institutions, we are highly fragmented. So the costs are going to be greater here. And within that highly fragmented environment, you have FIs of all sizes. So what it takes one of the largest, the 10 FIs in the country to make changes versus a lot of the smaller financial institutions are vastly different. Also, we have payment processors. So you have big core processors who will bear the cost, which will be ultimately paid by their customers, so to do upgrades for their financial institutions below them. So there are these buckets of costs. We're going out now to try to find out, what are those costs, how much will the processors change, and then what will the costs be day to day for financial institutions. And one of the things that we've seen as we've looked at this is that the part that's really the harder part for financial institutions is the posting. It is the making the funds available in a real time or in a faster manner to their customers. And that's the part that actually gives the value to the customers. But the financial institutions, most of them have core processing systems that are 20, 30, 40 years old because they cannot fail. They're the workhorses for the financial institution. And financial institutions often are loath to change them because what if the system fails? And we've seen in other geographies some of the big financial institutions who have upgraded their core platforms and then they failed. There have been system failures. So I think that that's one of the things that financial institutions look at is we cannot have a failure. Safety and soundness and certainty of payment are the most important things. Then we have regulatory pressures, and then on top of that, regulatory compliance, and then on top of that, we want to make things faster and innovate. So coming together to bring up all those buckets of cost is something not just in the process of trying to get our arms around now. We're hoping by late summer we'll have that. I think to consumers, I think it's to be determined whether the costs will at some point for a faster payment might be borne by a consumer, the FedEx model that Bob was talking about. The fact that maybe to get my payment to somebody tomorrow or the next day, that would be free, but maybe to get it in 2 hours from now, there might be a cost associated with that. I think that that's still, to be determined in a competitive marketplace. And I don't think that, I can say whether that would happen. I do think that innovation, though, is expensive, and it has to be borne, and you have to give properly aligned incentives for folks to want to try to innovate.
I guess my response to that would be that typically when you're trying to move the ball forward, if you want to push back, the first question you ask is, what's the business case, or how do you pay for this? And it's a legitimate question, but and it's very difficult for community banks because we're almost totally dependent on our vendors. And because of what's driven the vendor business is that just compliance issues have created a circumstance where it's very hard to be a vendor and provide all the compliance tools that a bank would need. So now we're down to a handful of big vendors, and they're frankly they're still cobbling things up together to make these things work. They're buying this and they're buying this and they're trying to interface it together. Sometimes it works, sometimes it doesn't work very well, but it's all very expensive to the community bank. So typically a community bank will stand back and wait and see what their vendor delivers, and then you try to figure out a way to either absorb the cost or possibly even generate some revenue. That's pretty hard to do. On the security side, that's just the premise of everything we do. Guarding our customer data and protect, their privacy is paramount. In the community banking world, they know who we are. We sit next to them in their kids' school events. We know them. We have to take care of their privacy. And sometimes, it slips through the cracks and we pay the price for it, but it's usually pretty minimal.
Thank you. Commissioner Cooper from Texas.
First of all, I've read the material you presented with interest. was about to say I enjoyed reading it, but interest is probably a more relevant term here. And y'all have made comments about this, the question I'm about to ask, and it falls under the why category, Mr. Steen, that you mentioned earlier. So first, to some degree, Britain has been able to make virtual payments now, or excuse me, instant payments now for supposedly for 6 years. So, and Mrs. Larimore, you talked about improving the timing on it. But then in 2012, in the NACHA meeting, there was an attempt to go to same-day settlement, and that didn't pass. It appears that you're talking about trying to improve it, and I guess Mr. Steen also said the same thing, to maybe not instant, but at least same-day settlement. But then you mentioned, Mrs. Larimer, that the banks, I believe the term you used, the bank could give the customer the availability of funds when they received it. So the could kind of bothered me to a degree. So the why question is, it appears that there has been at least some systems that do provide a quicker settlement, and it appears that we're trying to get there, but my question is why aren't we there yet?
A couple things. So in the UK, the faster payment system was a result of the financial institutions coming together under the threat of regulation or threat of a mandate, because their payment system, the BACS system, which is the ACH in Britain, had a 3-day, it still does, 3-day clearing and settlement, where the ACH here is overnight. And also in the UK, again, the size of the market is significantly, exponentially smaller than the size of the market in the United States. You mentioned, and I guess one more thing, in faster payments in the UK, there's two pieces of it. One is the messaging, of course, which sends the message that I want to pay Chris. The financial institution gives availability to Chris, but settlement only occurs in faster payments 3 times a day. And that is something that we're looking at with the ACH, is moving to a 3-time-a-day clearing and settlement to support innovation into the future. To the question of why in 2012 the same-day proposal didn't pass, I think it was a combination of a few things. I think first there was the work that had been done to cost it out, or that for some players that there were significant costs, and for the industry overall. But the thought was there wasn't enough value being given to all players with it. So that proposal only added 1 settlement window a day, not 2 that we're looking at now. That proposal for West Coast banks did not give a lot of value, because if you're looking at a 3 p.m. or a 4 p.m. settlement time Eastern time, it means that originators on the West Coast, 3 hours below that, needed to get files in by 11 a.m. or noon. And so that didn't provide a lot of value. So there wasn't, we called it a middle-of-the-road approach. We tried to take the kind of the least intrusive approach. And what we saw is, that there's still costs associated with that, but there isn't enough value for folks to want to try to use it. It didn't work perfectly well for same-day payday payroll. It didn't work particularly well for expedited bill payments. So what we're trying to do now is add 2 windows, try to give more availability, or more value, to the West Coast, so that the whole, over the whole United States, there's more value in there. And what we're hoping to do is then find that there's enough value to outweigh the costs that are going to be imposed by looking at a same-day service.
I would generally agree with that. There was a lot of competing forces. You had most community banks, for example, are net receivers. And as a receiver, the easy question is, what's in it for me? Why would I want to pay that item earlier? I would argue, and I do argue with my peers, that that's the wrong answer. We need to move this along, but because those same banks, typically in a community bank world, and we are one of them, if somebody walks in and deposits a check, we, for all practical purposes, give them immediate credit. We don't get availability for that item. With Check 21, it's much faster than it used to be, but now we get credit. We would hope to get credit, assuming the check's good, by midnight. And so there was just a lot of different competing forces. The clock, Eastern time, was a big issue. You get out to the West Coast, why, it's a whole different set of circumstances. But I was very involved in promoting it, doing what I could to promote it, and I'm glad that the Fed has moved to their enhanced same-day product. Don't have a lot of participation in it yet, but I think as the vendors, the community bank vendors, who have been largely supportive of the concept, at least in the response to the ballot question, I think we'll make some progress.
Commissioner Cooper, I just offer a few quick thoughts. I think one of the themes that's coming out of this panel is that at the end of the day, payments as currently constructed is a very difficult, logistically intensive business. I think for those of us that were involved in the remittance transfer rule promulgated by the CFPB, I think there was a lot of education of all the parties about how hard it is to actually move and settle funds internationally. And I think what that leads to, if you stay with me for a moment on the difficult, logistically intensive business as currently constructed thought, that leads to two conflicting ideas going forward. One is this increasing interoperability and efficiency question on the existing system. And that's where the questions have focused so far. How do we take our existing settlement system and make it more efficient, and how do we increase the interoperability? Another way to go about solving this problem, which goes to what Bob characterized as my 50,000-foot presentation, rightfully so, is disintermediation. The technologists are generally moving toward disintermediation. The non-bank financial services providers, the technology providers, are trying to leapfrog our current existing settlement system, which may or may not be a thoughtful way to go about it. But it is, as we as an industry, financial services, outside counsel, NACHA, Visa, the state banking departments, federal banking agencies, moving our existing system forward and innovating on technologies that have certainly innovated but are generally 30 and 40 years older, and a fragmented financial system creates challenges. We can continue to focus on our existing system, and people will, and in every sense, I think the card associations and NACHA and our banking system are going to be around for many, many years. Or there is an opportunity for technologists and non-bank financial service providers to innovate in a way that they don't have to grapple with the fragmented nature and the inefficiencies, and can move this forward too. So, and quite frankly, probably both will happen.
Commissioner Gonzalez from Tennessee.
Well, thank you, Mr. Chairman, and thanks to the panelists for being here. We certainly are grateful to you for the information that you're providing us. And I've got a question for the entire panel. I think it's a question that a number of people around the country have on their minds. The current payment system has certain controls built in for security and fraud mitigation. So how should we think about security, fraud mitigation within the context of modernization aimed at speed? In other words, how do we ensure appropriate coordination between speed and security? I'll start with Mr. Daniel.
I think there is an inherent tension between increasing efficiencies, frictionless transactions, and security, fraud mitigation, and I would add AML and sanctions compliance. And with the clients with whom we work, there's always this discussion about how do I have frictionless payments, how do I have frictionless transactions, and balance the security interests, the fraud mitigation, AML, and sanctions obligations. I don't have, Commissioner, a great answer for you here other than people focus on this every day, and I think there will ultimately be compromises in all processes so that proper attention is paid to all. The failure by a financial services operator to pay attention to security or fraud mitigation, or AML, or OFAC screening, is dramatic. And so you have to, as a financial service provider, balance the two. I will tell you, everyone gives thought to this, and they certainly invest funds in it, but it is a challenge.
I think that was an excellent point about the tension, because I wholeheartedly agree that it's there. I think from the ACH network perspective and the other electronic payment systems, safety and soundness, consumer protection, risk mitigation, and trying to minimize fraud through the payment system are all the things that the financial institutions, the operators, and the users of the payment systems, of the legacy payment systems, are invested in with huge costs to be able to put that into effect. So there are regulatory burdens also, but there is reputation risk. There are wanting to do the right thing for their customers. So there are huge costs that are embedded into the system. And then with some of the newer with payment methods, alternative payment methods, technologies, what you see is, I think in a lot of ways, businesses or payments being moved into a space without a lot of that, the trappings, without the costs. And so it seems very, it's seductive in a way, because you look at that and you think, well, you don't have all the, there may be no Regulation E protection for consumers. If your computer goes down and your virtual currency is there, you've lost your money. Or, so there may be a lot limited AML or OFAC screening. There's not a safety and soundness issue when you look at, how small virtual currency is right now compared to the existing big payment systems. So I think, when we look at that, you have to look at why people are wanting to use them, and why they are seductive, or why they are attractive to people. It's because they don't have all of the costs, the compliance costs, the risk cost, safety and soundness issues that the existing payment systems have. So the more we burden our existing payment systems, the more attractive these other things are for folks to want to use, because they're not burdened in the same way. But within the legacy payment systems, we're still grappling with these issues. I mean, today you have, even on the check side with remotely created checks, say, there's not centralized risk monitoring of those. You don't know if there's large-scale returns. We know that fraud tends to go in the path of least resistance. So the more controls you may put on the ACH, fraud will move off into either existing payment systems or into the new exciting things that are coming in the future. So I think that we have to look at the entire landscape and see if incentives are appropriately aligned, if the regulations are appropriately aligned, and find out why people might want to be creating new things, because there are costs embedded in the old.
Well, like you would expect, I don't think it's that complicated. Somebody has allowed the bad guy to get into the payment network, and it's just following that back. If I have a customer or merchant that initiates bad payments, fraudulent payments, I'm going to be responsible for that, and I'm easy to find. And that's all we need to do. I mentioned it early in my presentation that integrity is the key to this. We have to be careful with who we give a routing number over to. It's not for lease, it's not for sale. And when we continue to just say, okay, if you can give me 10 cents or 5 cents or 2 cents for every transaction, go for it. Well, that's what's getting us in trouble, and that's true on the debit side, on the card side, and on the check side, and on the ACH side. And so it's just a matter of responsibility. We have to hold people accountable. If you allow them into the payment system and they're a bad player, there's going to be a price to pay.
Thank you. We have time for one more question from the task force. Commissioner Hagler from Georgia.
Thank you, Chairman, and thank you to the panel for joining us today. This has been very helpful. In Georgia, we've been developing a merchant acquirer limited purpose bank charter with the goal of allow merchant acquirers to have direct access into the payment card networks. Whether it's that scenario or any other where a technology company has allowed direct access into the payment systems, what would be your hierarchy of the risk that are introduced with that model and what would be the major mitigants that you would seek to address that? And I'd throw it out to the panel in general.
So Commissioner Hager, I'll take you guys back to one of the slides that was in my presentation and sort of ridiculously simple analogy, which is the wagon wheel or the circle of trust, right? Where you've got the settlement entity in the middle and you've got the banks on the periphery. Settlement systems, payment systems only work because of trust. Let's go back to the Lehman Brothers bankruptcy in October of 2008. What happened? You had a number of financial institutions, investment banks, large commercial banks that were loaning to each other on an overnight basis, and it was a settlement network or a payment system of sort. And all of a sudden, because of the Lehman bankruptcy and the inability to assign value to certain assets on their balance sheets, they didn't trust one another. They were unable to look across the payment system, or in this case, the overnight settlement system, and determine that they trust their partners in settlement. And it froze. Hence, you had the lender of last resort, the Federal Reserve, step in, do its job, and provide liquidity to a frozen market. So when you ask about the introduction of technology companies into that wagon wheel or the circle of trust, you guys, as state banking departments and our federal banking agency counterparts, have to think about that. And actually, quite frankly, so do the payment systems. The one thing that will take down large payment systems very quickly is that loss of trust. And it can come about in a number of different ways. It could be a liquidity problem. It could be a solvency problem. It could be a regulatory problem. It could be a reputational risk problem. So that's a long-winded answer to your question, but when you think about prioritization and the risk of allowing non-bank financial institutions into the payment systems, I think what the regulators need to think about and the existing payment systems need to think about is that safety and soundness, trust issue that won't pose a risk to the existing payment system.
I have nothing to add to it.
I'm probably the wrong guy to ask. I think it's a very worrisome path to be taken. Integrity is critical, and I think Chris explained it much better than I could.
Okay, thank you. We actually do have some more time than I thought. So I'd like to ask Commissioner Leary.
Again, thank you to the panel members for coming and being with us. I'd like to explore a little bit deeper on that fraud loss side. I know from the customer's experience, from the bank's experience, they often stand behind that fraud loss, whether it be in the wire transfer or whatever. Can you elaborate more on what financial institutions are to protect consumers in that wire transfer environment?
Can't speak to the wire transfer.
Well, we're probably not a good example because our wire transfer volume is relatively limited, so we guard it closely. It takes, we know our customers, so even if we get a call for a wire instruction and we recognize a voice, we still do a call back. We have two people involved in the actual transaction. We use Fedline Advantage to do those wires, and our domestic wires, so you know, it's a very cautious process. It's well documented. We know who we're dealing with. We know the funds are available, and so we're probably not the high volume. Our customers can originate a wire on our wire cash management product, but it's as though they told us in person because we still do everything we would have done had they done that.
I think fraud mitigation is very difficult, and it's in many senses an IT arms race, right? And I think that we as a country and a financial services industry within the U.S., it's going to take a cooperative effort between federal law enforcement, state law enforcement, the Federal Reserve, Treasury, the financial institutions themselves, because I don't think any one financial institution, and you can take a top 5 bank or you could take a bottom 100 bank, I just don't think they have the funds or necessarily the ability to coordinate on a global basis to fight fraud in that manner. I think it's going to take either legislative or law enforcement or otherwise, and they certainly exist. I don't mean to imply that they don't, but it's a challenging issue in many respects related to IT.
Thank you. My colleague from state of Washington. For question? No, I'm fine. Thank you. Commissioner Breakspear, do you have any questions? So I'll ask a question of each of you. So are there any state or federal legal impediments or barriers to getting where you want to go, or where the public wants to go in modernizing the payment system?
Yes. Yes, there are.
So if the answer is yes, then specifically, what legal or regulatory challenges should we be thinking about?
Well,
Thank you.
A lot of things have gone through my mind as Chris made his presentation. So on the virtual currency, as a small bank, the Treasury prints money and then it's almost illegal to use it, right? The cash. We're reporting, we become policemen on reporting large currency transactions, and then $10,000 is the number that's sort of got locked in years ago. And so if a customer that we know comes in and deposits more than $10,000 or withdraws more than transactions, sets off a whole series of internal reporting issues, and we go into a state of paranoia of whether we've checked off every single check and verified everything for somebody we've known for 30 years. So that's an impediment, because we know that we're competing in an uneven world. And then ironically, my state now is promoting the payment of taxes and fees through a non-bank player. And it's really remarkable, because the money goes into a pooled account. If the state puts $1 in my bank, the pledging requirement kicks in. So it's extraordinary. And so, yeah, there's a lot of things at play that put us into a hopeless situation to stay competitive. And recently, the remittance rules on international transactions have really essentially taken us out of the game. So our customers are going to Walmart and Western Union, and it's unfortunate, because we can provide that service much more cost effective to the consumer, but it's essentially eliminated our role.
I think it's just a cognizance of the impact of regulation. I think there's a few things. One is players out there, end users, also want, to Chris's point, they want friction-free, they want ease, they want convenience, they want low cost. Oftentimes, the reason why you have to add friction or convenience is the safety and soundness issue, and it's regulatory compliance. So there is an end-user impact when you have layers of regulation upon it. I think also there's the price and impact of regulation. So today, financial institutions and it's just, I would say both state and federal, so it's the layering. Right now, their IT queues are backed up for compliance changes. So the last thing they can get in, generally speaking, are innovation or just nice to haves, because they can't get into their IT queues. They're still implementing Dodd-Frank. The remittances rule is part of Dodd-Frank. The regulatory burdens right now on financial institutions mean that innovation becomes the thing that comes below regulatory updates. And I think when you're looking at the future, there is, Chris had said, this tension between, now we have regulatory pressures on both sides. One is to add a lot of additional consumer protection, fraud protection, regulatory compliance burdens with Dodd-Frank, versus the feeling that we need to be moving faster and doing, the Federal Reserve public paper on payment system improvement. So you're getting caught between two sides saying we need to do better and faster, but you need to be doing these other 100 things too. So I think it's just a recognition at the federal and state level of the impacts of regulation and what are the most important things to have, and how do we get our arms around all of that and make rational decisions about where we need the payment system to go, and the fact that you do have other players out there who are saying, we can act without all that burden. We can create something new without the burdens you guys have.
So many of our clients are in Northern California, and of course, they're entrepreneurs, and entrepreneurs generally view legislation and regulation as wholly unnecessary, right? But with that being said, I think...
We take the opposite view.
And quite frankly, I do too. I share your view. So with that being said, I think the best things, Commissioner, that the state banking departments could do is provide certainty here. And the virtual currency area is a great example. I will say providing certainty here is challenging, and I'll finish with this comment. We've talked about the remittance transfer rule at various points, and the education that many parties had in the remittance transfer rule is instructive here. And ultimately, we have a rule which doesn't necessarily reflect the reality of payment settlement. And as Bob said, has, in my view, unfairly taken community banks out of the game because the rule was drafted in a way that didn't properly incorporate how difficult payments is. So, Commissioner, I think that you have a tough task, and all of you on the task force have a tough task in the sense that certainty is what industry needs, but it requires a high degree of knowledge, which isn't always easy to acquire.
Mr. Syracuse from New York.
There's obviously a lot of history to ACH and our legacy payment systems. Are there any best practices or lessons learned that could inform emerging payment systems going forward, both from a sort of a practical point of view and a regulatory point of view?
I think a few things. Ubiquity is necessary or desirable. I think you want to have multilateral scaling. You need to have rule sets or business rules that are multilateral in scaling, right? So you don't want to have a bunch of bilateral agreements. You need to have certainty in the payments. And talking about Chris's circle of trust, you want to make sure that that everybody trusts each other, that they know that if one player fails, that there can either be, the settlement can be recalled, or that you won't have systemic failure because of the failure of one participant. And I think the fact that consumer protections are part of our mindset, and so you should have consistency in the application of consumer protection so that there's not regulatory arbitrage. So it's not a rational decision for one player to use another payment system because that way they don't have to comply with something else. You want to have a rational consumer protection overlayment so that everybody knows the same terms in which they're playing, at least a few.
I think that was a great answer.
Yeah, the reality is, and I don't think it's all bad, that checks and ACH and debit rails work under different rules. And I think as we try to make these payments faster and give the beneficiary choice out there, I think we're pretty good. As a small bank, I can handle all three of those payments. I can work with all three of those channels, and I think I can give my customer a menu choice. How fast do you want this to happen? And there's going to be some kind of price differential because that's the only way we can make it work.
Well, I want to thank each of you for your comments and your discussion here this morning. We are going to take a brief break to transition to our second panel. We're going to begin promptly at 10:30. Thank you. Okay, welcome back, everyone. We now have our second panel, which will focus on retail payments innovations. Panelists this morning are Jason Oxman, Chief Executive Officer of Electronic Transactions Association, Louis Goodwin, President and Chief Executive Officer of Green Dot Bank, John Muller, Vice President of Global Payments Policy at PayPal, and Spencer White, who's the General Manager at MNO Partnerships at ISIS Mobile Commerce. As I've asked the other panel, please limit your statement to about 5 to 8 minutes so we have enough time for a good dialogue. So we'll start with Mr. Oxman.
Thank you, Mr. Chairman, and thank you for the opportunity to appear here today. Thank you, Commissioner Flores, for the opportunity to be in the great city of Chicago. At the risk of offending our host and ensuring that Mr. Syracuse ignores me for the remainder of the panel, I have to say, as a more than 10-year resident of Massachusetts, go Red Sox. I'm here to set the table philosophically on the future of payments innovation. And I want to direct everyone's attention to the great work of the economist and fellow Commonwealth of Massachusetts resident Clayton Christensen in his work, The Innovator's Dilemma. He talked about how incumbent industries with an entrenched history generally do not innovate because of the threat they pose to their existing businesses. Well, I'm here to offer you the thesis that the payments industry takes exactly the opposite approach to technology and actually has a very good story to tell that many incumbent industries do not have. You heard about that from Chris Daniel a little bit, talking about the record industry's response to online music, did everything it could to kill it because it was in the business of selling plastic discs and didn't know how to make money online. The payments industry over the course of the last 50 years has made itself truly indispensable to commerce in this country. It's truly not an exaggeration to say that all commerce at retail would come to a screeching halt in the absence of the payments industry. Our members at VTA, 550 companies across the payments ecosystem, processed $4.9 trillion in payments last year in the United States on behalf of our merchant customers. More than 70% of the GDP of the United States is commerce at retail, and more than 70% of payments made to retailers are via electronic means. Truly, the common enemy of the payments industry is cash. And we want to make sure that everyone has the opportunity, from retailers online to retailers in brick and mortar stores, to accept their customers' preferred form of payment. Now, over the course of the last 50 years, we've all been familiar with the plastic card with the magnetic stripe on the back of it. I'll make sure to cover up my number here since we're webcasting. That magnetic stripe is the same technology used in cassette tapes. That's how old it is. Now, of course, we're in the process of migrating in the card world to these chips in cards, the so-called EMV chips, which will help make these plastic cards more safe and secure. But truly, the future of payments is one of ubiquity of technology. And what that means is for consumers who have come to appreciate the value of electronic payments. Consumers in the United States carry more than 1 billion, with a B, debit and credit cards in their wallets. Those transactions are rapidly migrating, as are many of our other activities in our daily lives, to the mobile world. And the advent of mobile payments and the embracing of mobile payments and new technology by the payments industry creates enormous opportunities for merchants. Because mobile payments, like all forms of electronic payments, are safe, secure, reliable, and rewarding. And also, in some cases, they're kind of fun. This is my Pebble smartwatch. I don't know if you can see that on there. That's my Starbucks card on my Pebble smartwatch. Now, why would I want to pay for a cup of coffee with my watch? Because it's kind of cool. But it's also, let's not leave that aside. But it's also, again, for the consumer and the merchant, it's safe, reliable, and rewarding. Starbucks, as it happens today, is the single largest provider of mobile payments in the country. Why have they been so successful? Because it's a closed-loop system and it's very easy for them. They control their own issuing of the Starbucks card and the acceptance of the card. You can't use the Starbucks card anywhere other than at Starbucks. But it also means, as a consumer, that I can tie my Starbucks card to my credit card, my preferred method of payment, or to my PayPal account, which is how my Starbucks card is funded. And I can use whatever device I happen to like carrying with me or putting on my wrist in order to pay. It also keeps track of my Starbucks stars, so I don't have to carry that plastic card around. The migration to mobile payments is about, for retailers, enabling whatever it is that their customers want to have enabled on their behalf, while still maintaining the safety, security, and reliability of the electronic payments network. Now, to be clear, mobile payments are a very small part of the overall transaction volume in the United States today. I like to think of mobile payments as an area with very high interest but very low activity at this stage. Just to put it in perspective, I mentioned that $4.9 trillion figure is the payments processed in the U.S. last year. Depending on what estimate you go by, somewhere around 200 billion of that was mobile payment enabled. And surveys show that consumers that are using mobile payments, it's in this high single-digit percentage right now in the U.S., those consumers who have actually tried it. But again, we see the migration from that magnetic stripe to the mobile device. And if you think about adoption in other areas where consumers have used their mobile device for commerce, for example, it takes a very long time to change ingrained habits, but we're getting there. And we're very excited about the opportunities that mobile payments present. You know, the commercial use restriction was lifted on the internet in 1995, so just 19 years ago. And 19 years later, if you look at commerce in the US, the percentage of commerce that takes place online just passed the 10% mark last year for the first point. 90% of commerce is still in brick and mortar stores, nearly 19 years after the commercial use restriction was lifted on the internet and online commerce became possible. Now that number is going to continue to grow, but that shows you the growth curve we're on. The last thought I want to leave you with about the philosophical approach to new technology and mobile payments is this. When you think about the regulatory landscape and the need for involvement of government in mobile payments, I do think it's very important to realize conceptually that mobile payments are really a new means of initiating a payments transaction. It is not a new payments transaction. So whether the example I give you is my watch or my phone or the plastic card or any of the other great new technologies that are out there and that you'll hear about today on this panel, all of the protections for consumers, all of the fraud, zero liability protection that consumers know and appreciate, the reason they use electronic payments, all of that is still there. Because this new means of initiating the transaction that we're talking about and that we're so excited about is truly just a replacement of form factor. Instead of swiping a card or in the chip world dipping a card, I'm tapping my phone in the case of ISIS, or I'm typing my phone number in at Home Depot in the case of PayPal, or I'm holding up my watch in the case of Starbucks, or Level Up, a great Boston-based company that's using 3D barcodes on phones. All of these are means of initiating a transaction, but all of the very important consumer protections, all of the very important fraud protections, anti-money laundering protections, all of the things that are so important to all of you are still in place. Because at the end of the day, the transaction that you're initiating with that new form factor is still tied to those legacy, and I don't mean that pejoratively, but the legacy financial rails that you have all done so much work to protect on behalf of consumers and merchants. So in closing, ETA, as the trade association of the payments industry, is very excited to help our industry move forward, to continue to provide unparalleled service to merchants, to provide consumers the opportunities they need and desire in order to pay in the form that suits their needs best. And we look forward to having the opportunity for continued dialogue with all of you through the group here, through the task force, and through your individual state and Commonwealth operations to make sure that we do everything we can to help you understand why technology is so beneficial in the payments industry. So thank you very much for the opportunity to be here today, Mr. Chairman.
Thank you, Mr. Axman. Mr. Goodwin?
Again, thank you for the opportunity to appear before you today. My name is Lou Goodwin. I'm the President and Chief Executive Officer of Green Dot Bank, and I'm here to discuss with you innovations in retail payments. Green Dot Corporation is a bank holding company, and it fully owns Green Dot Bank, which is a state member bank located in Provo, Utah. And we are regulated by the Board of Governors of the Federal Reserve and the State of Utah Department of Financial Institutions. Our core product is the Green Dot card, which is a general purpose, reloadable, prepaid card. This card can be used to make purchases, pay bills, get cash, and to access funds, just like any other traditional MasterCard or Visa debit card. Today, Green Dot is the largest company in its space. We have over 600 domestic employees in Pasadena, California, Palo Alto, California. Bentonville, Arkansas, and Provo, Utah. And Green Dot's sole mission is to invent personal banking for the masses, and our sole focus is on low, fair cost, and easy-to-use banking services for the low to moderate income Americans. Our card features no penalty fees and no overdraft fees ever, and also includes short and clear, simple disclosures. Green Dot's card and reload services provide the consumer with 90,000 retail locations of which they can put money onto their cards, and we can also load money onto the cards through online and via leading store apps. And each year, Green Dot opens approximately 5 million FDIC-insured deposit accounts. And most of those people are either previously unbanked or underbanked by traditional banks. All of Green Dot accounts are fully FDIC insured and come with Reg E protections. We require customer identification just like any other bank would, and our accounts are compliant with the U.S. Patriot Act. Direct deposit is free and the funds are available immediately. Registering and using a Green Dot card does not affect your credit score. In addition, there are no purchase fees when you purchase a card online. And Green Dot products adhere to the customer covenant of clear disclosures, no minimum balances, and no penalty fees ever. Green Dot supports the application of consumer protections for general purpose reloadable cards, and also including guaranteeing deposit insurance for the customer's accounts and full Reg E protection, crediting funds to the account in a reasonable time and restricting abusive fees, and ensuring customers access to necessary account information when the customer needs it. And then Green Dot Corporation also operates the Green Dot Network, which offers the consumer the ability to add cash at retail locations to prepaid cards, and not only including Green Dot cards, but over 100+ programs that are prepaid that we support through our network. Earlier this year, Green Dot announced a new way for customers to add cash to their prepaid card. It is called Reload at the Register. Currently, our customers purchase a paper chit, which is also known as a money pack, and they add their cash to their reloadable cards at retail location. As the name implies, Reload at the Register lets the prepaid consumer simply go to the register at any participating retailer to conduct their cash reload transactions. The cashier collects the money from the consumer, and he or she wishes to and presents the card that he or she wishes to reload, and pays the reload fee and swipes the customer's card at the point of sale terminal. The retailer's terminal is connected to Green Dot's data processing center, where Green Dot is able to see the transaction in real time, and the real-time transaction method allows Green Dot to readily load reloadable funds onto the customer's account without any further action from the customer. Green Dot's Reload at the Register service allows them to enjoy faster, easier, and more intuitive reload transactions without the fuss of having an intermediary step of transferring from the paper chit. We expect the new reload experience to be fully implemented with Green Dot retailers as of the end of 2014. Green Dot is also a leader in the mobile banking space with our GoBank mobile DDA account offering. GoBank is the first account designed from scratch to be opened and used on a mobile device. Each GoBank account includes a checking account that is linked to a Visa debit card and an account called a Money Vault, which is designed for an easy way for GoBank customers to save money. GoBank features a consumer-friendly pricing model with no overdraft or penalty fees and no minimum balances. We offer over 42,000 free ATMs, and they are easily located through the GoBank app. And we offer a very friendly user interface, budgeting tools, P2P payments, mobile bill pay, and paper check payments, remote deposit capture, and free cash deposits at participating retailers. It is a fast, fair, and friendly consumer experience, and all accessed through a mobile device or online or via a tablet. Again, thank you for allowing me to appear today, and I look forward to answering any questions you may have. Thank you.
Thank you very much, Mr. Goodwin. Ms. Muller?
Thank you, Mr. Chairman, and thank you to the members of the task force for the opportunity to appear and represent PayPal at this panel on retail payments innovation. I think I'm the only representative of a company that is regulated by each one of your states. So my apologies in advance if some of what I'm about to tell you is redundant to you. But the fact that PayPal has been invited to a panel on retail payments innovation is one demonstration of the evolution of PayPal over our now 14-plus years of operation, from a company that started as a mainly person-to-person payment system to a company that is now focused really on commercial payments, and that is the bread and butter of what we do, especially for small and medium online businesses. So we've had the good fortune to grow now to more than 7,000 employees in the U.S., with customer service and operations centers in Nebraska and Arizona, and technology development centers in Austin, Texas, in Scottsdale, Arizona, and in Boston. And in my plug to the host, and my thanks to the host, I would also want to mention that just in last December, we acquired a great local Chicago startup that had done some really innovative things and continues to do innovative things in enabling payments for online websites and for mobile developers and merchants who make use of mobile applications, a company called Braintree, based here in Chicago, and its subsidiary Venmo, based in New York. So I think we're covering the majority of your states. The PayPal model is built on top of the so-called legacy payment systems that you heard from in the first panel, primarily cards and ACH. So sometimes referred to as disintermediation, but I think more accurately, we're just adding an additional intermediary to legacy payment rails, and we're paying a fee. Essentially, for every transaction, the money comes in from either card or bank, and then typically moves out through the ACH system, and we're paying standard fees to our bank processors on each of those transactions. So why is it that that PayPal has a role as an additional intermediary? Typically, you wouldn't expect intermediaries to be added if they're not creating some value or serving some role. So there are a number of reasons why small and medium businesses in particular choose to accept PayPal as one of their payment methods, or sometimes their only online acceptance method. Typically a combination of factors, depending on the merchant's own business model. One of them is cost, and we certainly aim to set our pricing structure so that the cost is lower than standard card acceptance. Our fee structure is based on standard card processing fee structure, where we charge the receiver and not the sender, and we charge the receiver, the seller, a fee that is a combination of a percentage-based fee plus a fixed fee, and we strive to keep that percentage-based fee lower than what they could otherwise get for standard credit card processing. Another reason why a merchant might choose PayPal is what we and others sometimes refer to as the push model rather than the pull model. So in standard card processing, the merchant is pulling information and funds from the consumer. And to do that, the merchant has to receive the consumer's financial information, either card or bank account. With PayPal as an intermediary, the consumer is pushing the funds through PayPal, and never has to share their financial information with the merchant. For many consumers dealing especially with a small business for the first time, they prefer that as an added element of security. And as a result, the merchants prefer that as something that's more likely to bring them new customers and to convert those visitors to their website or to their mobile application into buyers. And then another reason why merchants choose to accept PayPal is international exposure. And even the smallest businesses now through the internet are able to participate in international trade and export. And if they're selling goods that have appeal outside the U.S., in many cases they find that in some countries not as many consumers have a credit card, or they may not have a credit card that works internationally. And PayPal deals with those issues for them. We now accept buyers in 193 different countries, so we're helping those merchants to access international markets. So turning to specifically payments innovation, certainly we see consumer shopping behavior changing and retailer behavior changing, where the lines are blurring between traditional electronic commerce and physical world point-of-sale retail, and largely through the mobile device and the portability of the mobile device. And so we are following that trend, and certainly payments innovation in this area will be driven by retailers and marketplaces and consumers, and payment services will only be a partner in helping make that innovation happen. We're not going to be the ones initiating the change. It has to come from the retailers and the consumers. But certainly the mobile device has great potential to add some new features and some value to payments at the point of sale. As we've heard, it also have a fairly high hurdle to overcome because the existing payment systems of card and cash are well established. Consumers know them and understand them. Acceptance is widespread. So all the companies in this space have to provide extra value, and that's what we are all grappling with and trying to find the right mix of convenience and extra value in the form of perhaps loyalty or marketing programs. And then for some, perhaps the aspect of coolness that Jason mentioned, but certainly coolness by itself will not be enough to attract consumers to change their ingrained behavior. So all of us who are participating in these changes at the point of sale are looking for that combination of a new convenience and new value to the customer at the point of sale. At the same time, it's important to emphasize our core business is still very much the online and mobile merchant doing business, not necessarily with their customers face-to-face in person, but over the internet, over the mobile device. So we are regulated, as I mentioned, in all of your states and all of the other states that regulate payments as a money transmitter. So that's 48 states in total, plus the District of Columbia and Puerto Rico and Virgin Islands. So I can speak to the point that certainly it takes work, but it is something that new companies in this area can achieve and can go through the licensing process and make it through. Again, certainly takes work, it takes effort, as you would expect, but at the same time, it's not impossible, and we do see every day new investment in competitors to PayPal and others. So it is a growing arena. And with that, I'll conclude my remarks, and thank you again for the opportunity.
Thank you, Mr. Miller. Mr. White?
Thank you, Chairman Cotney. Thanks to the CSB as well for the invitation to appear before this body, and thanks to this task force in particular for your demonstrated leadership in this area. It's obvious that there are vast changes underway in the area of retail payments, and in particular in my space in mobile payments. But that innovation is happening often in forums or discussed in forums where people are using very common terms, generic terms that don't always belie the complexity and the diversity of technology's business models and implications for consumers under there. So thank you for digging deeper to understand the implications and the differences between the solutions that are being brought to bear and taking that into consideration as you do your jobs. So from a perspective of ISIS, what I would hope to do today is talk to you a little bit about who we are, not so much as a commercial, but to use ISIS as a lens by which, one lens by which you can evaluate an emerging payments play in the market. We were formed in 2010, and as you may know, we are a joint venture between AT&T, Verizon, and T-Mobile. And Chairman Cotney, I apologize for hitting you with the TLA, the three-letter acronym on my title there. MNO stands for Mobile Network Operator, hence wireless carriers. But we are an open platform. There are certain things that we are not that people don't always understand given sort of the nascent state of our development. We're not an issuer. We're not a payment network, and we're not a money transmitter. We are indeed a platform. So our platform is there to connect financial institutions with their existing customers and help facilitate commerce between the consumer, the merchant, and those FIs. So the platform that we provide for those parties allows for contactless payments using the mobile device. We did have two different pilots that you may have heard about last year in Salt Lake City and in Austin that were quite successful, gave us an opportunity to test and run our solutions, but we did launch commercially in November of this year. We had an announcement yesterday through a blog post that gave some insight to our current trajectory. So we are moving very aggressively to scale the business. We reported yesterday that our average addition of wallets per day is about 20,000 per day and trending upward. So we're very pleased with that performance. We think that that's going to continue and grow. But it also kind of underscores some of the things that color our decisions in the marketplace as ISIS. Being born of three large telecommunications companies, scale is something that's very important to us. And when you consider the things that ISIS does in the marketplace versus others, we are focused on driving scale because we believe that scale or innovation without scale is simply a science experiment. And we want to make sure that as we scale, we do it appropriately so we don't trip ourselves up, but also unduly cause harm to the rest of this industry as it's coming up. So to talk about our principles a little bit, these underscore everything that we do as ISIS. As a platform, we are centered around this idea of choice. We are agnostic in the way that we approach our business. We are agnostic to devices, to wireless operators, to operating systems, to payment types, payment networks, and financial institutions, whether they be existing institutions or perhaps emerging institutions that will be providing payment services in the future. Privacy obviously is a very big watchword for us. The way we have architected our solution, we are very careful to honor the privacy of consumer data. We are not, as some would have presumed along the way, part of the transaction flow. We do not see transaction data. We do not harvest transaction data. We are simply a mechanism by which a consumer can select a payment device that was issued by a financial institution and present that at a point of sale. And I've got a slide that will talk about some of the ecosystem roles later that discuss that. But we are really a facility to allow for the presentment of that device or that credential at point of sale. And then once that is ingested by the point of sale, the same type of transaction settling and clearing that happens today with a traditional magstripe card happens in a very similar manner that it does today. From a security perspective, I'll tell you, coming out of the telecommunications world, I was with Singular and then AT&T before coming to ISIS. I've done quite a few mobile payments and mobile banking trials and launched some commercial services. Without fail, whenever we have done a trial around mobile payments, the first thing that comes out of a consumer's mouth is, wow, that's really cool. The second thing that comes out of their mouth is, oh no, what if I lose my phone? security is top of mind for everyone in this industry, whether it's regulators, service providers, or consumers. The good thing is that for mobile, I think we have a very good story to tell at ISIS. I believe we certainly do. But it's a story that must be told. From our perspective, the way our solution is architected, we have a number of inherent benefits that are brought to bear through the mobile technology. One of which is that all of our wallets are PIN code protected. So to use and access those payment credentials, you have to first enter a PIN. Secondly, we offer a one-call or one-click freeze. If a consumer were to lose or misplace their phone or have it stolen, a single call or click on a website can freeze that wallet until it's found. Or if they need to replace it, then we can establish a new wallet for them. We also, through our network of customers on the institutional side, financial institutions, can provide an early warning system as well. So we have the ability at that one call or click not only to freeze that wallet, but to notify the financial institutions who hold credentials in that consumer's wallets, so they can undertake whatever fraud mitigation and other procedures that they feel are necessary to protect that consumer and their interest as well. The other aspects around security for us that I think are unique is that today we offer dynamic CVV, so the card verification value that's associated with each transaction changes every time you make a payment using an ISIS wallet. So that makes it obviously much harder for someone to intercept and counterfeit or clone a counterfeit of that account. So those are all in place today. In simplicity, this is something we're always focused on. We endeavor to do better every single day on this. Mobile payments is not a common concept to a lot of consumers. As we implement this and we try to take into consideration all of those security considerations, all of the business requirements of the partners and brands that are associated with it, we have to be on the front line with the consumer and make sure that it's easy to understand and easy to use. So looking at the evolution here that we're pursuing, it's been mentioned several times today. I know Jason had made a comment or two around the age of magstripe technology. It's clear with the recent data breaches, the push for EMV, and also the accelerated push for tokenization that magstripe has really run its course. But magstripe served us well for many decades, and it's also set the bar for what consumer perceptions around ease of use and acceptance are. Its acceptance footprint is extremely wide, it's very easy to understand, and it's highly reliable. So as we transition into mobile, those are table stakes. But what the mobile brings to the table that wasn't there for magstripe are a lot of attributes that can be used by any number of service providers. But the fundamental ones are that you essentially have a computing platform in your hand with an interactive data network, a graphical user interface, and an ever-present and often trusted form factor. So that's the promise that it brings. Now, how people actually utilize those to deliver services, you will see a myriad of ways, and I'll tell you a little bit about ours now. For us, we use a technology known as near-field communication to effect communication from the device to the point of sale. It's also known as NFC. NFC in and of itself is a radio technology, not too dissimilar from Bluetooth or Wi-Fi. It's really short range, 4 to 6 centimeters is the broadcast distance for successful transmission, and it's good for bursty transmission, so you won't be streaming a lot of music over NFC. But it actually makes it very convenient and adds to the security profile of mobile payments when you're using a short range technology like that. With NFC, if we'd had this panel 2 or 3 years ago, it would have been a forthcoming technology. Today, you'd be hard-pressed to find an Android device that's being sold by the major carriers that does not have NFC in it. And of those, with our partner carriers, the vast majority of those are what we deem ISIS-ready. They are companioned with not only all the certifications that come from us, from EMVCo, from the device manufacturers and the wireless carriers, but it also comes with the use of a secure element. The secure element is a smart chip, a hardware-based solution in which all the secure credentials are stored, and that'll differentiate us from others who use cloud storage or software storage on the device. And we're based on the Global Platform Standard, which is an international standards body that is focused on the provisioning and maintenance of credentials and smart cards. And we're also compliant with EMV. When you think about the multi-sided market that exists when you're trying to innovate around payments, obviously the merchant's acceptance has to be a major component of that. Today, we're seeing about 25 of the top 100 merchants who have already deployed or are in the process of deploying contactless technology. That's important when you consider the footprint of retail payments today for MagStripe. We're nowhere near that, but the concentration of contactless is in very important places. From our wallet perspective, that's how a consumer experiences our product. We support payment cards, loyalty cards, and offers, and we are accepted by quite a few of the merchants that are out there today, in the hundreds of thousands, moving towards that 1 million mark. From an ecosystem perspective, I touched on this a bit before. I would encourage you to think about us in our current form as evolutionary and not revolutionary. We take advantage of the infrastructure that is in place today for issuers. They are still the issuers of these credentials. They own that consumer relationship, and all of the regulations and consumer protections that are associated with their products still persist today. For merchants, they are playing the same role that they always have. They have a different form factor to accept payment and offers and loyalty from, but their relationship between the issuers, the consumer, and the payment networks is unaffected. So fostering the mobile payments, part of the focus that your organizations have is trying to understand how to protect consumers. I would just underscore in sort of closing remarks here that stability is really important for innovation. In our case, we are, in the role that we play, we are taking advantage of the regulations and consumer protections that exist today. So as was mentioned by Jason, all of those same protections around fraud liability exist because this is just another form of an existing payment association card. And I would ask that as you look at new facets of mobile and you consider new regulations around that, to think carefully around decomposing the different solutions that are in the marketplace, because although we use a lot of the same terminology, we do approach it very differently. And the potential for unintended consequences is real if a sledgehammer approach is taken versus more of a surgical strike. You know, a federal example to throw out there that caught us in our industry was the Durbin Amendment. All right, that was not really focused on mobile or innovation. It was really focused on interchange around debit cards, but it introduced a number of wrinkles that have caused a lot of rethinking and rework, in particular the dual routing for debit cards. That capability did not exist and is just now starting to exist for contactless payments, whether it be mobile or card. And that's driven a lot of delays of getting support for debit cards and a lot of additional investment. So I would just use that as one test case, but I'm sure there are others that we should be mindful of going forward. Other than that, I appreciate, again, the opportunity to be with you and look forward to answering your questions.
Thank you, Mr. White. Let's start with Commissioner Leary from Utah.
Thank you, Mr. Chairman. Thank you to the members of the panel who have come before us today. I'd like to follow up a little more with Mr. White's comment, but apply really the question to all three that have a product or a service they're offering. The high-level question is, what are your inhibitors to further adoption of your product or service? What slows you down? And subset of what Mr. White has always addressed, are there laws and rules that are prohibiting your further adoption or your customers' further adoption of your technology? Love an answer from all three of you.
Sure, I'll be happy to take the first stab at that. You know, for us, the major inhibitors aren't regulatory at this point. They're just really the market dynamics that are in play. We do, under our current technology focus on NFC, require that merchants have a contactless acceptance capability. That is growing. We'd like it to grow faster if it could, but uncertainty in that area of the market does inhibit us a bit. Certainly with the discussions around rolling out EMVCo and the acceptance or resistance to that can delay the deployment of new point-of-sale readers that would include, in most cases, NFC. From a consumer perspective, we haven't seen it as an inhibitor yet. We've seen quite a bit of enthusiasm around mobile payments, and in particular our solution that we put out there. But we are mindful and somewhat wary of other services that may come up that could have an incident and undermine the confidence. So we're very diligent, and we encourage our competitors to be very diligent in the protection of consumer data and to avoid any unfortunate instances that could taint the adoption of mobile across the industry.
So I would agree that the main inhibitors at this point are not regulation, and it is figuring out that complex mix of merchant acceptance and consumer choice, choosing a new way to pay over something they already know, and in most cases that they like and have grown used to. Specifically on the regulatory side, I would say perhaps there are two things worth noting. One is that there's a role, I think, for regulatory agencies to play along with the industry and others in just spreading the word or educating the public that the consumer protections that apply, say, to a credit card continue to apply if you pay with the credit card as your funding method through a mobile phone, the same way that they have applied if you use the credit card to pay online or if you use a credit card by swiping it at a machine. So I think again, the industry certainly has to take the lead, and we're trying, but there is a role for regulators to play as well. And then I'd say one last thing, more at the federal level than at the state level, some of the disclosure requirements, as you would expect, were not written for a mobile first world. And so the regulators are moving, they recognize that and are moving to adapt, but there's still a ways to go in some of the disclosure requirements that worked well in the physical world or the world of mailing paper or even putting a statement on a website don't work as well on a mobile device.
Yes, thanks for the question there, Commissioner Leary. I think the largest inhibitor to us in the underbanked and underserved space is that our consumers don't know who to trust. They may have had experiences with banks before, and they had extremely bad experiences where they were either fired by their bank or they fired their bank, if you will, because of fees that they just could not absorb. So a lot of what we have to do is help the consumer understand the products through clear disclosures, through fee boxes that can clearly let the consumer understand how they could use the product and how they could benefit from using the product and not being caught by fees that are unclear or under-disclosed. So I think that is what we need to do is to continue to educate the consumer and make sure that we provide clear disclosures so the consumer can understand what they're buying before they buy it.
Director Jarvis.
Thank you, Mr. Chair. I think I'd like to build on what my friend from Utah was asking you about, and I should probably start with Jason. First of all, I gave up wearing a watch many years ago, and my daughter does not think I'm cool at all, so I may talk to you afterwards. But it's truly amazing the amount of innovation in this. I've been a regulator for a long time, and it's hard to keep up for us, really it is. So I'd like a little counsel from you. You know, the market picks winners and losers. Regulators don't have that luxury. We have to take it as they come. But we also don't want to spend valuable resources and limited resources dealing with a technology that may not make it. So what advice would you have for us as we continue our consumer protection role, our safety and soundness roles? What advice would you have for a regulator in terms of fundamental guidelines for the future for the technologies that are not represented at the table, but may be here next year?
Well, that's a great question, Director Jarvis, and I appreciate it. And obviously, being in Washington State, you have a number of companies under your purview, Starbucks being one of them, Amazon being another one that's very active in the payments industry. So I can certainly understand why the question arises, and it's a great question about the approach to technology. I think the fundamental premise is, and this is why I focused in my opening remarks, about thinking about these changes in technology as a new means of initiating a payments transaction as opposed to a new payments transaction. That allows you as a regulator to focus on the entities that you have traditionally interacted with. And I'll go back to the example of Starbucks. Starbucks has somewhere behind them a payment processor. And a payment processor has to be, by credit card network rules, attached to a financial institution. So JP Morgan Chase, which has a branch, an operation called Chase Payment Tech, which is an ETA member, actually processes the transactions. And obviously, as a state banking regulator, there are some banks that are under your purview and some that aren't. But at the end of the day, it is the financial institution that bears responsibility for compliance with state and federal regulations and laws related to the actual movement of money. So I think, and I love the direction of your question, because what it suggests is that the reflex of the state regulator is not necessarily, well, there's a new technology, somebody's making a watch, let's go hold them responsible for moving money around. Obviously, Pebble or whoever else is making a watch should have no responsibility for people's money because they're not actually doing it. What they're doing is using e-ink technology to generate a 2D barcode that then goes back and is tied eventually to my PayPal account, and my PayPal account is tied to a credit card. So there is a traditional financial institution involved in that transaction, and I think you're right. Philosophically, the approach should be, let's look to the entity that has been held responsible for and will continue to be held responsible for those consumer protections, protecting consumers' money, and still will be involved in that transaction chain even as we move to a new means of initiating that transaction.
If I could add, so I think the question really lends itself to a framework that is something that really your state's already familiar with, which is in the credit card processing and acquiring world. And as Jason suggested, to a large extent, it's a story of follow the money. There are already merchant acquiring companies and payment gateway companies today that help merchants process card transactions, that are handling data and helping transactions get completed, but are not handling money, and today are not regulated, and that system has worked, at least in my view, quite well for a long time. For companies that are handling money in some form, like PayPal, with the opportunity that we have for consumers and merchants to carry a balance, really the essence is the 100% liquidity requirement that is part of all your state's money transmission law, and that goes a long way towards, I think, giving you some comfort about not having to pick winners and losers, as you suggested, because even if a company winds up not succeeding in business, as long as they are maintaining the right liquidity, their customers are not going to be harmed. It's only unfortunately, their stockholders and employees. But the 100% liquidity requirement gives you some comfort, I think, of not having to pick winners and losers.
Yeah, I would agree with both Jason and John's comments. I might just add, though, that with respect to technology, the strategy that I might employ is to think of technology as an ingredient in a recipe and not the recipe itself. In most cases, and again, I'll use what I'm familiar with, ISIS as an example, we use near-field communication to affect that communication. We could use Bluetooth, we could use barcodes, we could use Wi-Fi, any number of different things. But at the end of the day, the function that we provide, the functions that's being provided by the other ecosystem partners, and the flows of data and money would be exactly the same.
Thank you. Commissioner Breakspear from Florida.
Thank you, Mr. Chairman. When you talk about mobile, it just reminds me that in the first quarter of this year, Florida had 26 million people come and visit the state, so they're highly mobile. We also had 1 week in February, when we were the only state without snow on the ground. And with that, I'll aim this a little bit at PayPal, but I think it broadly impacts all of you. In PayPal, they talk about observe, orient, decide, and act, which implies some form of feedback loop that you have built into your various systems. My broad question is, while you have this real-time feedback, have you contemplated at all sharing information on problems, systems failures, red flags, and the like with your regulators? And while this is aimed at PayPal because you sort of put it out there, I think I'd like to hear from the others as well. Broadly, do you see this as an opportunity to interact, and have you even thought about it?
So we have thought about it. I'd say maybe not enough with the regulators and with your agencies. Certainly today, we mainly try to do that through communication with our banking partners, both the ones that provide service to us directly as a processor of a card or an ACH transaction, and then we have signed up for the federal program that allows for sharing to prevent money laundering and terrorist financing. So we do try to participate in those ways, and certainly would welcome suggestions on how we can do better with your agencies, because we certainly recognize that it's a complicated ecosystem, and we want to play our part, and certainly would welcome the information coming in two directions. Certainly there are cases where, for example, a card issuing bank may know something about a card being bad or potentially compromised, and we would love to find a way to know about that as well before someone tries to use that card on PayPal.
Does anyone else want to address the question of sharing?
I just want to make sure I understood the question correctly. You're asking about sharing of information with bodies such as yourselves, or you're talking about in real time related to transactions? I wasn't clear on that.
Really sharing information with bodies such as ourselves.
Oh, sure, yeah. So both Lou and John and I all participate on the Federal Reserve Mobile Payments Industry Working Group, which is a body that's been active now for, I think, 3 years. That's one forum that we all get together in a cross-industry fashion. That is with the research side of the Fed, but we do have periodic meetings as we had, I guess it was last week. Chairman Cotney was in attendance to that as well, where we do meet with regulators periodically to talk through issues, share thoughts, and understand concerns and needed actions. We, as I'm sure the other, my esteemed colleagues here and their companies as well, are also very active in direct outreach to various regulators and are eager to respond to any questions that come up. I know I've met several of the folks on the panel in the past to do just that, to kind of share our perspective and thoughts on the marketplace.
And I also agree with the others' comments. I mean, to be able to share between entities a known fraud or a known scam would be very helpful in any way we can make that stronger to make sure that while the consumer is protected, that also we are keeping bad elements out of the system. I would encourage that.
And the payments industry obviously has a very strong interest in rooting out fraud wherever it exists, because the way, as everyone on this panel knows, the credit and debit card industries operate, consumers have zero liability for fraud, and it's actually the card issuers that have to take responsibility in the first instance and protect consumers from any fraud. So any concerns or questions you have about steps and measures that our industry is taking to continue to protect consumers against any fraudulent activities, and also to just understand how the technology works to continue doing that, we are always delighted to have the opportunity through this forum or more directly to provide the kind of information that will ensure your satisfaction that we're doing what's necessary to protect consumer interests.
Thank you. Commissioner Gonzalez?
Thank you, Mr. Chairman, and thanks again to this panel for being here and sharing your thoughts with us. On the first panel today, we talked about security. We'll continue talking about that here. And we talked about it with respect to modernization and the aim of increasing speed. I would like to ask ISIS and PayPal to talk about your systems and products in the context of security and how you would compare that to the traditional payment systems. Do you have features that the traditional payment systems do not include? And we'll start with my fellow University of Tennessee grad, Mr. White.
Go Vols.
Go Vols.
Yeah, thank you for the question. Yes, we do bring to bear certain additional security measures that aren't available in other form factors. But as we mentioned before, obviously all the fraud protections around the payment product are the same ones that are there. For us, and I think generally for mobile, the advantage here is that you have more authentication factors than you've had in the past, right? The ability to not only use a PIN on a device, but to verify the equipment is the right equipment that's associated with an account. There's things you can do around those. But principally what we talk about is the PIN protection first and foremost. As I mentioned in the opening remarks, for the ISIS wallet to operate, you have to enter a PIN into it. It will not function, will not communicate with a terminal. The credentials that are issued by the banks and that are stored on that smart chip are highly resistant to tampering. They are, if you were able to hack them through some supercomputer you have in your basement and get that information, it would not be easily usable elsewhere. As we mentioned, there's a dynamic CVV component to that, which means that you have to crack that as well and figure out how to do it. The other inherent benefit, I think, to the architecture we have where these credentials are actually stored on the device and not in the cloud is that we're not a very interesting hacking target. ISIS does not retain any of that information in any of our servers or systems. They transit our systems when they're being provisioned, but after that, they are gone. We do not retain the keys that allow access to that information once it's inside a secure element. Those keys are turned over to the issuer, and then they're rotated by that issuer, so we have no access to them. Contrast that to cloud-based storage, and I'm not picking on cloud. Cloud's got a lot of great advantages, but you've got a big concentration of information in one server site or in one central location. That seems to be much more attractive if you're organized crime, for example, versus trying to hack each and every individual's device that's out there.
So a couple of things I would mention. One I mentioned during my presentation, the contrast between the push system and a pull system. And by using a push system, the fact that each merchant who accepts PayPal is not getting your card number or your bank account number. So PayPal certainly has to keep it safe, but the number is not being spread around throughout the world, the commercial world. And we think that's an important security element. Then behind that, PayPal really, and probably every payment company to some degree, is fundamentally a risk and fraud management company. And so it's a matter of building models over time that get continually better. So, it's never good enough, and we always have to keep improving, but certainly our losses from fraud today are much lower than they were when we started 10 or 11 years ago, and we have to continue working on that. So even in the case, of course, where we do still rely primarily on username and password to access an account, our system is looking for much more than that to actually process a transaction. So not just the username and password, but also how new is the customer, what is their IP address, what are they buying, all these things are being modeled. And then I'd say the other element worth noting, and it is not really different than the card systems, but in conjunction with them, is of course the card systems, Visa and MasterCard particularly, have done a lot to publicize their zero liability program for unauthorized transactions. We have the same system, so even though federal consumer protection would allow us to impose some amount of loss on the consumer for unauthorized transaction, we don't use that, and we have the same zero liability, and we extend it to bank-funded transactions through PayPal, not just card-funded. So that's an important element as well of helping the consumer feel secure.
Thank you. Commissioner Cooper, do you have a?
Well, just a short question, and John, this is to you. You know, one of the things that we try to do, we're obviously in the regulation business, but we're also trying to reduce burden if we can. So in a company such as yours that has licenses all over the country, do you think the usage of the NMLS system is beneficial? Are we headed in the right direction in that regard? And that's not a leading question, right?
The short answer is yes. We welcome any drive towards more consistency and uniformity in state regulation, both in registrations and reporting and examination. And the NMLS, or using the mortgage licensing infrastructure, is helpful in that regard. Of course, you know, as entrepreneurs, we were always somewhat impatient, and progress is never fast enough. But it's certainly the right direction to keep working on and keep going in.
Thank you.
Commissioner Hagler?
Thank you, Chairman. Thank you again for being here to visit with us today. Kind of as a follow-up to Commissioner Gonzalez's question, you know, there was a retailer that really made the news around Christmas time with a significant breach. And so my general question to each of you would be the products and services that you provide. If a customer was using your technology and made the payment in the store, would that have made any difference in terms of folks losing their data through that breach?
Sure, I'll lead off on that one. I believe I've heard of the breach that you're speaking of. You know, I'll come back to the dynamic CVV, right? I mean, I think that's the principal protection that would have been very valuable in that instance. So if for whatever reason they were able to abscond with the card number, and if they were to get to use the CVV that was used, they would have no ability to replicate that card, because the next time it was used, the issuing bank would recognize that was a previously used CVV, or would recognize that whatever CVV that was placed next in line was not the predicted value, and they would have been able to detect that as a fraudulent transaction.
Yeah, if I could, Commissioner, just from the perspective of the payments industry broadly, obviously these retailer breaches are enormously damaging to consumer confidence in the protections afforded the infrastructure. So we all share an interest in making sure that these kind of things don't happen again. I think in the case of the large retailer breaches that happened over the holiday period, we now know a little bit of information about how those breaches happened, and they were actually, as we now know, breaches of the retailer's own systems. So the means by which the transaction was initiated, whether it was a magstripe card or a chip card or a phone or a watch or whatever it was, actually would not have prevented the breach, because the breach was someone essentially stealing network access credentials, in the case of one large retailer, from an air conditioning contractor, and then using those credentials to get into the systems. But what is important is, and you've heard a lot about this technology here on the panel today, things like tokenization, where, as Mr. White mentioned, you replace the transmission of card data with an actual one-time use token that, even if it's intercepted, wouldn't make any sense. the EMV chip in the cards, which makes it impossible to counterfeit a card, to use the fruits of your criminal activity. End-to-end encryption, which ensures that every touch point into the payment systems is encrypted as opposed to just some of them. All those things that we're deploying out there in the marketplace will help further secure the systems. And I do think the move to new payments technology, like you've heard today, will go a long way to help those technologies move forward.
Thank you.
And thank you, Jason. That was largely my point, is that I know the MAG card is getting a rough rap in this meeting today, but I'm not sure that that was the end-all problem in that very high-profile breach.
Right. Secretary Flores?
Thank you, Mr. Chairman. I do have a quick question, and it goes to a lot of the security issues and just the way that the regulators work with all of you. Historically, in the non-depository space, and particularly in your areas, the regulators, the examiners have been using more of a compliance approach as opposed to a safety and soundness approach, which really looks more at prudential regulatory analysis, which looks at risk. What's your perspective as we're seeing new technologies, new systems, and I got to tell you, I get really concerned when I hear the things impossible or very hard, because nothing's impossible. The reality is all of these individuals who are out there trying to do harm are trying to figure out right now how to crack into your respective systems. So the vulnerability and the risk is always there. As examiners, what can we do better to work with you to apply and better understand and focus on this risk? And is the compliance model better or not? And should we be looking at more of a safety and soundness approach going forward?
No, that's a great question, Commissioner Flores, and I think the states have always been such a great incubator of new innovation, and you're always the first people that see and try to regulate it even before it gets to the federal regulators in a lot of way. I do believe that the risk-based approach has to be the element that we and you employ together, and to get away and evolve away from a checklist that everything is as important as it was 10 years ago. I think that there are definitely new technologies, there's new approaches that if you can see that and see how we manage that either internally or with the vendors that we deal with, and that you can really understand not just the technology but the flow and the protections, I think it'll do all of us a lot of good.
Yes, so I would certainly echo that, and I think already that there is a fair amount of that approach of moving away from a strict, just a check-the-box checklist to more of a risk-based overall safety and soundness approach in looking at information security. And as you say, information security is never ending because the bad guys are always coming up with new techniques, or new risks are being created. So it's a challenge we all face, and I think in addition to changing the approach to more of a risk-based approach rather than a checklist of requirements that were created 10 or more years ago, I think it's also working together on the right kind of training at both state and federal levels and with the industry, just to keep track of what is best practice or state of the art in building information security system.
I don't disagree with any of that. I would clarify my earlier comments because I'm sensitive to your take, which I agree with. You always have to be vigilant. You always have to be innovating. You can't believe that what you have is impregnable. But the risk-based approach really gives you the mindset that says you have to deploy a range of dynamic countermeasures, right? Not just the ones that we can talk about in this public forum, but other things that we and others do behind the scenes, right? And that's an area where I think more interaction between service providers and regulators can add some clarity to that.
Yeah, I do think it's important to remember in context, our goal as service providers is to enable the flow of commerce. So we're focused in the first instance on making payments happen. And the only reason, as we talked about before, that consumers feel confident in electronic payments is because they know they're protected if anything goes wrong. Last year in the U.S., there were about $6 billion in fraud losses on the credit and debit card networks. And you'll remember that's on a denominator of $4.9 trillion in payments processed. So we're talking about less than 5 cents out of every $100 in payments processed have some fraud component to them. So it's a very small, it's a fraction of a tenth of a percent. But we want to drive it out of the system entirely, and obviously want to continue to protect consumers. And as you correctly noted, criminals, as we deploy new technology, are not suddenly going to go find a job. They're going to find some other way to penetrate our system. So we do need to remain vigilant to make sure that we protect our customers.
Commissioner Leary, did you have a quick follow-up?
I did have a quick follow-up. Since I'm on the more mature, experienced end of this task force table, Mr. Goodwin for Green Dot mentioned that their focus target was really the unbanked or the underbanked. For PayPal and ISIS, is there a focused audience that you're looking at, or is the adoption with the under 30?
So I'll start. So I'd say for us, the focus is really mainstream America. You know, e-commerce now is very much a mainstream activity, and certainly that includes the so-called underbanked. For us, we do have a commercial partnership with Green Dot to enable Green Dot cards to be used to fund a PayPal account. So that's one way, but also I'd say more generally, it's just the growth of prepaid cards in general that can be used on the PayPal system as a funding method. But it happens because the underbanked, are shopping. They do have mobile phones. They're shopping online even before they had mobile phones. But we're not really actively targeting them as a separate segment. We just include them in the broader spectrum of all consumers who like to do online shopping, and that's really our target.
Yeah, for ISIS as a platform, we're broadly inclusive. The appeal of our service is a portion of it is the new facility that we bring to bear. It's also the products and the brands that are contained within that facility. So, for example, with American Express being one of our institutional customers, they've got a broad base of users. They have a division known as Serve, which is also present in the ISIS wallet, which is a prepaid account, and that I think tends to skew more towards younger and, in certain cases, underbanked or unbanked. So we service all of those. From a technology perspective and a handset perspective, since we're smartphone-based, smartphone adoption has reached the point where it's gone well beyond the tipping point, and it's adopted across all demographics and age groups. So we do see adoption and use across the broad spectrum, but as you might expect with a new technology, the fattest part of that curve are early tech adopters and people that are typically 40 and under.
Thank you all very much for your comments. We appreciate that. We are going to take a 5-minute break since we are officially now running slightly behind, and we will. Our third panel will be on virtual currency. Thank you.
Thank you.
Thank you. Our final panel today will focus on virtual currency. The increased interest in virtual currency and other payments innovations has led to the rapid emergence of different types of currencies and payments mechanisms. The virtual currency panelists will provide an overview of virtual currency regulations in the emerging marketplace. And with us today are Brian Krohn, Chief Financial Officer of BitPay, Karsten Behrend, Chief Compliance Officer of Zappo, Megan Burton, Chief Executive Officer of Coinex, and Anne Marie Tierney, Executive Vice President legal and general counsel at Second Market. And as I've asked the other panels, if you could please limit your comments to 5 to 8 minutes, then we'll allow us some good dialogue. So, Mr. Crone, please start.
Thank you, Commissioner Cotney, distinguished members of the task force and the state banking commissioners for the opportunity to speak with you today. My name is Brian Crone. I am the CFO of BitPay. I appreciate all of your interest in the commercial and international trade uses of virtual currencies and for reaching out to the community to better understand opportunities and risks that virtual currencies present. BitPay was formed in May of 2011, so that has been operating for 3 years, which makes us pretty old in this space today. During this time, we've acquired over 30,000 merchants to accept Bitcoin with our service. Our merchants include small, medium, and large-sized businesses in every state who accept Bitcoin side by side with credit cards as a form of payment. At BitPay, our role in the Bitcoin ecosystem is very close to that of a traditional merchant acquirer in the credit card space. Our software helps merchants clear and settle transactions over the Bitcoin network. BitPay is not an exchange. BitPay is not a Bitcoin bank. And we do not have any consumer-facing services. Consumers have no risk of loss from our service. BitPay is committed to being a good corporate citizen. We employ a strict KYC policy to protect against money laundering. Our KYC policy follows the best practices of traditional merchant acquirers. We need to know who our merchants are and what they're selling. We only want the good actors on our platform. Bitcoin does have risks, as other forms of payment do. Criminals use cell phones, email, US dollars, and banks. BitPay shares the task force policy goals to protect consumers from fraud and money launderers, keeping money launderers away from our business. We implement a risk-based approach for merchant acquisition as recommended by FinCEN, BSA, and the Patriot Act. This approach provides increased CIP and KYC due diligence as the merchant's daily sales volumes increase. All BitPay merchants must provide identification and contact information and are verified for the types of businesses they are engaged in and that the business is compliant under U.S. law. Personal interviews by BitPay are required at the highest tiers. We also conduct ongoing monitoring of merchants' transactions to ensure visibility into potential money laundering and CFT activities. In summary, BitPay's policies and procedures are guided by regulations that have served the financial community well, and we will continue to track and comply with all existing and future regulations and recommendations. Guidance from the IRS, the Treasury, the Department of Justice, and SEC have all established that those dealing with virtual currency must simply follow existing tax laws and anti-money laundering regulations. Bitcoin is still in its infancy. It's much like the internet of the 90s. If we look 5 or 10 years in the future, we're going to see many companies built on Bitcoin-related technologies. And we want those companies to be based in America, creating jobs in America, and building a revenue and tax base in America. I commend the task force for realizing the real and practical uses of virtual currencies and the potential future applications of the technology. I thank you again for the time to speak today.
Thank you, Mr. Crone. Mr. Barron?
Good morning, Chairman Cotney, and distinguished members of the task force. I'm pleased to have the opportunity to speak with you today. My name is Carson Barron, and I'm Chief Compliance Officer of Zappo, a United States-based digital currency company that's developing a new standard for institutional-level security and user convenience. At Zappo, I help guide the company's operations while driving high ethical standards of compliance. I'm also proud to serve on the executive board of the Northern California chapter of the Association of Anti-Money Laundering Specialists, or ACAMS as it's more commonly known. I'm the co-chair of the AML Compliance Committee for Data, and I also serve on the Regulatory Affairs Committee for the Bitcoin Foundation. Additionally, I volunteer my time as an active board member for the BitGive Foundation, which is a charitable organization that leverages the utility of Bitcoin for worthy causes. The virtual currency financial services ecosystem is highly evolving rapidly. At Zappo, I'm part of the team that offers high-security Bitcoin storage, as well as an expanding suite of Bitcoin-related financial products. a team with 2 decades of experience in international financial services and transactional security, has developed our proprietary storage product, the Zappo Vault. The Zappo Vault meets the storage needs of the most demanding global institutions, as well as the needs of individual users, and is fully insured. In short, the goal of Zappo and myself is to expand upon the existing infrastructure of Bitcoin and to provide the public the proper tools to harness its power. It is through this continued development of the underlying infrastructure that we will see the protocol continue to evolve and flourish. We're here today to discuss the consumer protection concerns around Bitcoin and other virtual currencies. In the very early days of Bitcoin, there were companies that did not have the proper preventative security measures in place, and due to this, they incurred losses on behalf of their institutions and their customers. More recently, there have been virtual currency companies that did not employ best practices in several facets of their operations. And unfortunately, as is evidenced in recent years, this is not a phenomenon that is unique to this emerging industry. A common qualm about virtual currency is the term decentralized, which can seem startling to people unfamiliar with the Bitcoin ecosystem. Bitcoin is a decentralized system and is unregulated in itself, but is fully regulated when it is used to provide established financial services. Virtual currency-based financial service providers are subject to many of the same rules as non-virtual currency service providers when they provide many of the same services. If we treat the regulatory environment of this technology differently from how we would treat other financial service providers, we'd be violating the regulatory principle of technological neutrality. Virtual currency-based financial service providers are subject to many of the same rules and as non-virtual currency service providers when they provide these very same services. Virtual currencies are unique in many other ways. A virtual currency such as Bitcoin holds out a number of powerful beneficial social and economic outcomes, including global financial inclusion, improved financial security, and enhanced financial control. I am motivated by these tangible benefits that Bitcoin has to offer, and it would be regrettable if the world were denied the many benefits of Bitcoin due to short-sighted reactions and the challenges that come with this new emerging technology. In short, we need to develop thoughtful, nimble, and sensible policies that protect the public without stifling innovation and economic growth. As you know, the system in the United States with regulatory bodies in each state has many benefits, but it also runs the risk of raising regulatory costs to the point that they are prohibitive and they send smaller, more innovative Bitcoin businesses overseas. That dynamic could defeat your consumer protection initiatives because virtual currency-based financial services might become dominated by non-US companies in which US regulators have limited ability to influence or control. Though most uses of virtual currency fit into existing regulatory boxes, there may be some areas where virtual currency's different properties would necessitate different treatment. When this appears to happen, it should be the subject of careful study and dialogue within the virtual currency and regulatory community. Agencies and government officials have achieved powerful results when they've drawn on the expertise the virtual currency community has to offer. This community includes the staff and volunteers of the Bitcoin Foundation, such as myself, who have regularly consulted with and provided testimony to both state and federal agencies. I'm here in that vein today, and I hope I can answer your questions about Bitcoin and virtual currency as a technology, about innovative solutions, such as those developed by Zappo and my fellow panelists, who have regularly, as well as emerging trends with the Bitcoin ecosystem. I hope that today's hearing will begin a conversation that leads to thoughtful, stable, and uniform regulations throughout the states and the nation. I'm pleased to have the chance to participate in that dialogue with you today. Thank you.
Thank you, Mr. Behrendt. Ms. Burton.
Thank you for the opportunity. My name's Megan Burton. I'm the founder and CEO of CoinEx. CoinEx is a currency exchange. We're the first regulated exchange in the U.S. serving cryptocurrencies. We're a secure and trusted marketplace, and we assist in the international trade and investment by enabling currency conversion across multiple digital currencies, as well as in and out of traditional fiat currencies. But a critical part of our business, our model at CoinEx, is our dedication to compliance. We currently hold money transmitter license in over half the states and have applications pending in the other half. We believe that compliance, with federal and state law will make our business stronger, and it will help us serve our customers better. I personally have spent 16 years in the IT security servicing Fortune 1000 companies. In the security space, specifically around GLB and PCI compliance. In the spring of 2012, I read an article about a security breach that had intrigued me. But hidden within the text of that article was a relatively unknown cryptocurrency that had yet to make the headlines. My curiosity led me into venturing into a global transaction. And it was at this moment that I realized that the status quo of remittance and payments as we know it today would never be the same. No longer did I have to wait through the traditional banking payment timeframes to send a payment 6 figures across the globe. No longer did I have to do a micro transaction where it absorbed my margins. But I had the freedom with the use of virtual currencies to fundamentally change the payment system's paradigm. The advantages as I saw them were simple. 1, transparent and neutral. The information is available in the public block. 2, secure and controlled. The most counterfeit-proof currency in existence today. 3, fewer risk to merchants, lower cost to consumers. Payment freedom. No banking holidays, no borders, no limits. Micropayments. Without the 10 to 40% fees that financially punish the unbanked. But most importantly, a system built on a foundation of security and transparency, because all the information needed resides in the public ledger. As an IT security person, this enhanced security fascinates me. Cryptocurrency is a true innovation. It is a triumph. Through some clever cryptography, a proof of concept scheme, we have a network that we agree on in a common ledger. In March of 2013, cryptocurrency made the mainstream news. We all read the headlines. And in the worst way, cryptocurrencies defined what we now were. However, this news led regulators to some important steps to provide some much-needed clarity around cryptocurrencies. FinCEN ruled that exchangers were transmitters. Luckily for me, I didn't know the complexities, nor the delays, or the regulatory maze I was entering into. While the FinCEN ruling determined that we were a money transmitter, we found challenges through the process of compliance. If I had a magic wand today, and I could contribute to the insights of the last 18 months based on my experience of obtaining the license at the state level, I would provide the following suggestions to help achieve our common goals of regulatory clarity and consumer protection. I'd ask for state cooperation, information sharing, state working groups to educate one another. I would ask that states help with the cost of doing business, especially if they invite us out to educate them. Instead of stating, you can't do business until you meet every requirement that has yet to be defined, meet the minimum requirements of the box we already fall into, which is money transmission. Give us a probationary license so that we can get that process moving forward and the capacity to do business, prove ourselves to have the capacity to do business within your state. Permissible investments should not be dollar for dollar value to every cryptocurrency that we hold. Risk-adverse rules create obstacles, and obstacles can sometimes create unnatural behaviors. Today, there are extremely long wait times in the processing of applications. There are certainly states where we have stalemates. Some applications have been in for over a year, and we're unable to determine the path forward as it's not a clear process. I understand and strongly commit to consumer protection. I commit to the Bank Secrecy Act through the implementation of anti-money laundering programs. I commit to meeting policy goals that have been set forth. I understand that we're dealing with complex issues and that as regulators, you've got to get it right. Along those lines, though, I applaud you. I applaud the approach of the task force, especially Georgia, Massachusetts, and New York. Thank you. You've taken the leadership role in looking at the issues of virtual currency. But I would ask that you not think about this issue only as a risk proposition, but as an opportunity. The innovation that virtual currency holds for issues such as consumer protection and payments is extraordinarily vast. We believe, because of the strong consumer protection laws and the approach here in the U.S., that it is the absolute best place for my business to be located, regardless of the regulatory scheme in place. But realize this is a global marketplace, and companies like mine will exist. The question is, will they exist in the U.S.? My response would be yes. But in order to do that, we need access to regulatory clarity that we seek. Thank you.
Thank you, Ms. Burton. Ms. Tierney?
Thank you. Chairman Cotney and members of the task force, my name is Anne-Marie Tierney, and I'm the General Counsel of Second Market Holdings, Inc., which is a New York City-based company with a couple of different businesses. The first is Second Market, Inc., which is a registered broker-dealer, and it's a platform that enables private companies and investment funds to raise capital and provide liquidity to shareholders. But I'm also the General Counsel of the Bitcoin Investment Trust, a private investment vehicle that enables institutional and accredited investor individuals to invest in Bitcoin. On September 25th, 2013, our subsidiary, Alternative Currency Asset Management, launched the first U.S.-based investment vehicle for investing in Bitcoin, to which our investment manager serves as a sponsor. The BIT, as we call it, is a statutory Delaware grantor trust that passively holds Bitcoins. It has no other operations. Investors acquire shares in the BIT through our broker-dealer, and the BITs, which also acts as the BIT's authorized participant. It's structured very much like an ETF, if you're familiar with that structure, other than the fact it's not publicly traded. We created the BIT to provide investors with a professional solution to gain exposure to Bitcoin in a structure that solved for many of the problems of direct Bitcoin investment, such as having to wire funds to unregulated exchanges in foreign jurisdictions, as well as concerns around Bitcoin safekeeping and ownership. In addition, by transacting through Second Market, our registered broker-dealer, investors gain the protection of regulatory oversight, compliance procedures, and a FINRA-registered trading team. In the 8 months since we launched the BIT, our assets under management have grown to over 105,000 Bitcoins, approximately $46 million at today's price, with over 140 accredited investors. The majority of these investors are entities, including family offices and private trusts, and high net worth individuals willing to invest at least $25,000. It's important to note that the BIT is not currently registered with the Securities and Exchange Commission, and the securities being sold in the BIT are issued pursuant to Rule 506C, a private placement exemption. And as such, that we're only open, as I said, to institutional and suitable accredited investors. So in addition to its activities as sponsor to our Bitcoin Investment Trust, our asset management subsidiary, Second Market, our broker-dealer subsidiary, markets and offers shares in the BIT and facilitates the investor transactions. As a registered broker-dealer, Second Market is responsible for verifying the accredited investor status of every investor, carrying out anti-money laundering processes and procedures, and completing FINRA's required Know Your Customer procedures, including a stringent suitability review. Our suitability process includes having each investor complete a detailed questionnaire specifying the details of their current investment portfolio, past trading history, risk tolerance, and investment intent. We review this information carefully and then reach out to potential investors to verbally confirm that they understand the risk profile of the investment. We have a private placement memorandum that my CEO likes to brag and not brag, has about 30 pages of risk factors, which I think is a good balance between where I want it to be and where he wanted to be, but it's a very robust document. And because we're generally soliciting for investors under Rule 506C, we also review all of the investors' financial documents to verify that they're actually accredited investors. We're one of the first companies to take advantage of the general solicitation ability after that piece of the Jobs Act became effective in September. Once our broker-dealer completes the processes and determines that an investment in the BIT is suitable for the investor, the broker-dealer sources Bitcoin in an amount representing the investment and then delivers the Bitcoin to the trust in exchange for shares that it pushes down to the investor. Second Market holds the Bitcoin through a highly secure process until delivered to our Bitcoin investment trust in exchange for newly issued shares. At no time do BITS investors have capital exchange for Bitcoin and vice versa. Instead, the investors are indirectly investing in Bitcoin through an equity investment in the BIT based on the NAV per share calculated on a daily basis based on a 24-hour volume-weighted average price that we base on the major U.S. dollar-denominated Bitcoin exchanges. We're an active buyer in the Bitcoin market, sourcing Bitcoin not just for our trust, but for a number of sellers in the market, including merchants that accept Bitcoin as payment, merchant processors, early adopters, and Bitcoin mining companies. In every instant, we require the seller to complete a new account profile for full AML purposes and KYC purposes, including full legal name, address, social security number, employment information, tax IDs, along with a copy of government-issued photo ID. Once we obtain that information, we carry out our standard broker-dealer anti-money laundering processes, including background checks through LexisNexis and Google, as well as an OFAC search. These same procedures also apply to buyers in the market in the event that we're selling on somebody's behalf, as when we have an excess position in Bitcoin or investors choose to redeem their BitShares in exchange for cash. We'll generally sell the Bitcoin through an exchange that's implemented their own AML procedures for exchange participants, and to the extent that we identify a potential buyer in an off-exchange transaction, we run the buyer through the same process that I described for sellers of Bitcoin. As a registered broker-dealer, we're subject to FINRA examination on a 2-year exam cycle. All of our employees that trade in Bitcoin are registered representatives with FINRA and have all their licenses. And in accordance with FINRA rules, we also maintain a system to supervise all of those registered reps. The system is subject to ongoing testing and review, and our anti-money laundering process is audited on an annual basis by an independent firm. In connection with our expansion into Bitcoin trading, we also amended our broker-dealer written supervisory procedures to include the Bitcoin trading activities, including procedures for documenting each trade and retaining all related documentation. And we also institute a company-wide insider trading policy, much like we have for the securities that we deal with, which limits our ability of all of our employees for buying or selling more than a certain number of Bitcoin without going through me and our Chief Compliance Officer. I applaud the Conference of State Bank Supervisors for taking a proactive role with respect to virtual currencies and determining what changes, if any, are necessary with respect to the current regulatory scheme. As there remains a high level of uncertainty at the state level regarding the status of virtual currencies from a regulatory perspective, I believe there's a tremendous opportunity for the CSBS to take an approach that provides clarity without being overly burdensome, supporting a growing business segment while also ensuring for adequate consumer protections. Thank you again for the opportunity to speak, and I'd be happy to answer any questions.
Thank you, Ms. Tierney. I'm going to start with Mr. Syracuse from New York.
A question that's open to the whole panel, but perhaps Ms. Tierney would like to start. Should investing in virtual currency like Bitcoin be limited to accredited investors or open to retail investors as well?
In my view, I look at Bitcoin more as a currency than a security, so I don't think it should be limited to accredited investors at all. I think you saw a lot of pushback in the context of the Jobs Act, where a lot of investors were very unhappy that only accredited investors could get into some very interesting investment opportunities. I know that the SEC has been charged with looking at that accredited investor definition this summer. Right now, only 7% of the American population qualifies as an accredited investor, so limiting investment in digital currencies to that limited pool of investors, I think, doesn't seem sensible to me. If they can go and buy a foreign currency on, CoinEx or any other exchange, I don't see why Bitcoin should be treated any differently.
I agree. I think it's just the fact that Bitcoin is in its infancy that was an early, risk-averse step that may change.
Yeah, I echo the same. I believe that once we have an educated customer base and with proper disclosures in place, that it could be adopted by the mainstream as an investment.
Thank you. Commissioner Hagler?
Thank you all for being here, and please know that the time and expense that you bear to be here is not lost on us, and we feel that your presence is of high value. My first question is for Brian. As you know, in Georgia, we were working with the merchant acquirers on the traditional side quite a bit, and learned a lot about what we thought were risk initially that turned out to be maybe in a different ranking than we had originally thought. Could you speak to us in terms of, to dispel maybe, or maybe not, the concept that it's the Wild West for nefarious activity in the Bitcoin world, as to terms of, what do you do to eliminate or deny service to merchants that you don't want to do business with? Can you give us some ideas of what those industries are, if not necessarily names of those entities? But then on a more positive side, how does your cost structure compare to traditional merchant acquiring?
Sure. Well, because it is such an early stage, we've been very thoughtful in the types of merchants that we allow on our platform. And online gambling is obviously illegal. We don't allow firearm dealers or any of the medical or recreational marijuana retailers that are in some of the states on our platform. It's way too early for that, and there's plenty of other business, e-commerce business, that if we could just get up 1% of it, we'd be doing very well. So at BitPay, we have this escalating KYC policy, and we partner with a company named CoinPliance to do our merchant onboarding. So they do all of the document verification, the scrubbing of the website of the merchants to ensure, looking for keywords essentially that would violate our terms of use. We do that up front for everybody. We OFAC check everybody, and if there are questions that come up from a yellow light or a red light ranking from our partner, we investigate personally. So we try to run as many through as we can in an automated way. It's the only way we can scale. But right now, only about 30 to 40% are getting that minimum $100 a day tier to process. After that, it does take some manual inspection. So we're very diligent. We think that it's very important. As Megan said, compliance is a pillar of our business. It has to be. We wouldn't have investors, we wouldn't have banks, we wouldn't have an auditor if we weren't doing the right things in their view as a merchant acquirer. So to the last point, what was the last point?
That was more of the softball piece. How's the cost structure compare?
Sure. The cost structure is very, very low. I mean, the cost to process a Bitcoin transaction is nominal. And as such, BitPay has employed a SaaS model of pricing approach for merchants. So no longer are you being charged as a merchant with transaction fees. We do have that as a starter plan if you don't know which level you want to fall in for a monthly service, and it is 1% compared to the 2, 3, sometimes even higher percentage that merchants pay on credit cards. So it's quite compelling to a merchant to accept this as a form of payment. And then, depending on the features and benefits and support that's required by the merchant, you can choose a plan, a monthly plan that best suits your needs, and basically process for free after you've met that monthly commitment.
Thank you. Commissioner Breakspear?
Good morning. We obviously are trying to learn about this as part of the CSBS and figure out a standard set of regulations, potentially. And I'd be interested, given that we had this instance in March, which is going to end up in the courts before very long. And without a real framework of regulation around virtual currencies, it could be that the courts effectively rule on what the regulations are going to be, and you're going to get stuck with that. Do you have any commentary or concern about being in that position, and how would you view a step going forward?
I'll go. When we were labeled as a money transmitter, CoinEx specifically, I fit into the box 94% if I had to guess. There's an outlying 6%, things around monetary value and the definition of it, permissible investments and stored value. There's very specific areas within the statutes that make me scratch my head and say, how can we overcome these minor obstacles? With items as they're approaching now, I think if we had had the framework in place back then, these last 6% of remaining items would have already been tackled. They would have already been dealt with, and we would have already been progressed past the point of the discussions that we're sitting here having today. I do think that regulatory compliance is important, and I think it's key for our business specifically, CoinEx. In order to create a consumer protection mechanism, it needs to be there. But we need to work through that last remaining component to solidify it.
I would just suggest that we see the same problem. As I said, my company has two different business lines. One is transactions in private company stock, and one is this Bitcoin business. And we've seen problems in the way that state laws don't work together across common boundaries around securities transactions. At the state level, that's caused a lot of issues for businesses who are looking to provide liquidity to their shareholders. I would hate to see the same thing happen around digital currencies, where there's not a common approach, where it's subject to court interpretation or different commissioners taking different positions. I think that's not going to be good for the digital currency market, and it's going to make the U.S. very non-competitive when it comes to other jurisdictions. And I think, as Megan said, I think no one wants to see the digital currency market shift out of the United States because of a regulatory framework that doesn't actually truly support investor protection issues, but is more a reaction that there needs to be rules in place that are not necessarily the right level for the risks involved in the transactions. So I would encourage all of the commissioners and the states to work together to put a common framework in place so that you don't have an issue with the court creating rules in Florida that wouldn't exist in Massachusetts or another state.
Thank you. Commissioner Cooper?
I too thank y'all for taking the time to be here today and respect that time. Some of the panel members mentioned that Bitcoin was in its infancy, and then we had comments like you need to follow best practices, so I assume the best practices are in their infancy also. But one of the things, and first I'll direct this to Ms. Burton, in the MSB space, let me back up. We understand innovation, and I think everybody on this this body here feel like that we need to go forward in order for the payment system to go forward. But in the MSB space, we deal with startups all the time, and so I'm having a little bit of trouble trying to determine why you think that the cryptocurrency area should receive special consideration. And then I'm going to follow up with that. I think, why shouldn't the capital requirements, minimum net worth be applied, permissible investments be applied, and bonding requirements, et cetera? So Ms. Burton, would you start with that, please?
Certainly. Mr. Cooper, I think I might have been misunderstood. We have met the MSB requirements in the states in which we've applied. We've put the bonds up, and we've committed to the regulatory framework that exists. However, in many states, Texas is the exception here. In many states, the definition of what we are and what we do has not been aligned with the statutes of that state. They don't know where we fall or how to handle the permissible investment, whether the surety bond will cover the permissible investment. The reason being is it boils down to the definition of monetary value, and if a state has not decided that definition of monetary value, it leaves loopholes and gaps in the market. I'm not saying negate the fact that there is a regulatory framework which we agree and abide by. I'm saying that where those small gaps exist, why not allow us to approach the regulatory framework that exists today, act within that framework while the state continues to resolve the internal issues of what their definition of monetary value might be.
Okay, and it also seems to me that it would, that response would include while best practices were evolving too.
The best practices that we follow are the traditional markets as they are today. We didn't look at the cryptocurrency space to try to define something. We said, what is the system doing? How can we fit within this system? There's technologies out there that do transaction monitoring for banks. Apply those. There's technologies out there for AML. There's laws that exist. There's rules that apply. We didn't want to reinvent the wheel. We just want to alter it slightly to be able to encompass a new currency pair that didn't exist prior.
Anyone else care to address that?
I would echo what Megan said. I mean, when we say best practices, and we mimic merchant acquirers. Most of them are in Atlanta or in Georgia. And there's a reason why BitPay is in Atlanta. We're following their lead and have implemented the same steps that they do for their merchants to a T. So the policy that we put in place is not in its infancy. We've completely replicated it. We only have 30,000 merchants today, so we need to be able to scale that. But I would say that in the absence of new regulation, we're doing everything that a First Data or a TSYS would be doing.
Yeah, I would echo that as well. Applying the best practices of the existing financial institutions, and then coupling that with some new innovations in transaction monitoring, customer onboarding for CIP and KYC, and tailoring those to the specific nuances within our emergent technology.
Thank you.
Commissioner Gonzalez?
Yes, thank you, Mr. Chairman, and thank this panel as well for being here and sharing your thoughts with us. Before I came to Chicago, I had some good conversations with a couple of folks in the Bitcoin community in Nashville, and we were talking about the philosophy of regulating this space, the balance of innovation and consumer protection, and they freely shared their thoughts with me, and I'd ask you all to do that with us if you'd like to talk about that philosophically. And then specifically, as you talk about that, are there certain technological tools or capabilities that we need to be more mindful of as state regulators as we regulate this technology-driven space? Mr. Crone, I'm going to start with you.
We're big proponents of the technology developing, and alongside of that, the security developing alongside. We, at BitPay, have been very transparent on what we do in our state and at the federal level. As long as security and fraud detection continues to be built at the same rapid pace that the Bitcoin network is evolving, I think that we'll always have the kind of visibility into the public ledger that we need. I think that's about all I can say on that. I'm not technically astute enough to.
Do you have any thoughts for us from a philosophical standpoint on balance of innovation in this space and consumer protection?
Well, since we're not consumer-facing, I probably am not best to answer that question. But to the extent that BitPay is a merchant acquirer, we graciously, Commissioner Hagler has let us come over and talk with him about what we're doing, and we continue to do that with our banking partners and anybody that'll listen, really, the FDIC included.
Okay, thank you.
So, yeah, I'll leave it there.
And there are some unique attributes in Bitcoin, such as the public ledger system, that allow visibility and transparency to not only consumers but regulators. In addition, leveraging things such as technological controls as well as physical controls and safeguarding funds, can ensure a deeper level of safety.
I would say that what we're seeing today, it's a revised model of what already exists. When you look at the movement of money, it's actually rather fascinating and complex. If you look at the MoneyGrams and the Western Unions, and you look at how money traverses from one side of the globe to the other, and the steps and the processes it has to go to get to there, that part intrigues me. When I engaged in this space, the fascination for me was a model that took a couple of steps out in the ease and facilitation of a new protocol, a protocol that essentially could replace the framework or the backbone as it exists today. You're probably very familiar, I'm sure, with how a Western Union or a MoneyGram and how the money moves. This is simply a more innovative or newer model on that. It's a way in which we can transact that opens up a level of transparency to everyone. That's the fascinating component of it.
Since we're not a MSB or a money transmitter, I really can't add much to the remarks that the rest of the panel's made.
I would add one other thing just about wallets and consumer wallets and the security that needs to be elevated in those wallet services. A lot of innovation needs to happen there. Simple username and password is not enough security. And to the extent you're providing protection to consumers, having that secure wallet needs to be moved along.
So, Mr. Crone, you said you're not customer-facing, and I don't know whether any of you would say that you're a customer-facing organization, but at some point, a consumer buys a Bitcoin or sells a Bitcoin. And it could be through, online, their phone, the Bitcoin ATM, whatever that we have in Massachusetts. Other states have they've started popping up. So where does the idea of consumer disclosure enter into this? Because at some point we'll have the opportunity to meet with some consumer groups and get their thoughts. But I'm trying to hear from you first in terms of what does a consumer need to know? I mean, this is not an FDIC insured product. Clearly, this is how much are they paying in either U.S. currency or in virtual currency to be able to make that transaction happen? And how do they, so what do they need to know, and how do they acquire this information? So I'd like to hear from each of you.
This is part of the framework as we have today. For me, it's very simplistic. What does the consumer need to know? They need to know the risk involved, a disclosure statement. They need to know the fee structure, which is produced when you provide the receipt. They need to be educated. How does the system work? How do I transact through it? Know-how from the system itself. I think those, for myself specifically, are very easy to accomplish, because when you read through a state statutes of being an MSB, it clearly tells you must provide these items to the consumer for consumer protection. Each state has a different statute or a level of disclosure that they want to happen. But that was probably one of the most eye-opening aspects for me when I said that I was lucky that I was naive when I fell into this. I sincerely mean that. I truly did not know the maze of complexity that I'd be stumbling through. In hindsight, it's been extraordinarily helpful to be able to speak with the states, to be able to speak with their examiners, to be able to get understanding of why does this system apply and how do I extend that out to the consumer-facing end of it. I think that they're there. Obviously, there's varying intricacies among the states, but those three components would be key.
Yeah, I would agree. I mean, it's really the point at which, how is the consumer getting Bitcoin? Through an exchange? Then they need to be educated there. I think your website, CSBS website, has a good statement on educating consumers about the risks of virtual currencies. But certainly they're not going to go seek that out. It needs to be at the point they're purchasing Bitcoin or exchanging Bitcoin.
And I do applaud the CSBS for rolling out the recent statement and the states for following suit and issuing their own statements. I believe that, through consumer disclosure, that a well-informed consumer is an empowered consumer. And through these types of initiatives, both at the purchase points and through overall messaging from individuals such as yourselves, that there will be ensured safety to the ecosystem as a whole.
And I would just echo those thoughts, and also, I think as the market develops more and the pricing transparency becomes more accessible, and the volatility declines as dark, deeper pools of Bitcoin are formed, that the volatility become less of an issue. And if you are transacting in Bitcoin and you know what the exchange rate is that the merchant is getting from the processing company, so you understand what your dollar to Bitcoin conversion, if it is US dollars, that'll assist the consumer in understanding, the cost to them of the transaction. And then I think not just CSBS, but also Nassau and the SEC and other regulators are doing a really good job about, letting consumers know about the risks inherent in Bitcoin utilization, and that, again, will continue to develop as people become more familiar with Bitcoin. A year ago, I was at a dinner party of 15 people, not one person besides myself knew what Bitcoin was. Now I'd say 14 of those people are familiar with Bitcoin, and maybe 3 of them own Bitcoin. So it's just an evolving market, and we'll continue to see the developments as uptake, as merchant uptake continues.
Thank you. Commissioner Leary?
I actually wanted to follow up on that consumer guidance that the task force issued. That was the first thing we focused on and issued. I'd love to hear your views on it, more with respect to, did we get it right? Are there other issues we should have addressed? Are there issues that we didn't address? Or was any of the tenor tone in the statement inappropriate?
I would like to reread it and look at it that, under that, with that. But I think that every point that was made was accurate. So is there things that are there things that are missing? Perhaps, but I'd love to have the opportunity to give feedback.
And I invite all of you to reach out to members of the virtual currency community for crafting those statements. We're happy to help. And overall, I thought it was well crafted. There were the references to malicious behaviors, as there are with traditional payment systems and cash as well.
I would agree. I think I'm glad you're a regulator and I'm not. I realize that at times our actions aren't really realized until they're actually put into play and executed. And I think that time will tell as to whether or not there could have been something additional or something that might have been left out.
I would have no comment on. I thought it was well done.
I would solicit, the panel's written comments. We'd love to receive them and be able to consider them here.
Thank you.
Thank you.
Secretary Flores.
Thank you, Mr. Chairman. Had a question with regard to, you may have heard the last comment, a question I had for the last group with regard to the difference between compliance and a more prudential regulatory approach. We saw what happened, for instance, in Mt. Gox and what has come out of in terms of what were the risks and what was the ultimate breakdown that led to the theft of the Bitcoin. So my question is, if we were to use, let's say, a more traditional compliance examination approach that you find in most of the money transmitter state laws, would we capture that? And I asked that question in terms of, do we, as we're moving forward in this space, do we have to reevaluate the way that we examine this space, and in particular Bitcoin, to ensure that the great protections that you're offering consumers are actually manifested in the actual practice of the operations? So I'd like to hear your comments on the prudential versus compliance.
I believe you hit the nail on the head, specifically with Mt. Gox, just to speak from my knowledge of it. The framework was there. The warning was handed out. I think the gap was the enforcement and execution. We all knew when the FinCEN guidance was issued that we fell into this realm of money transmission. At that point, we had to make a decision. Do we proceed forward, knowing that we could potentially be in violation, or do we retreat back and abide by the obligations that are set forth? I had that decision to make, along with many, many others. Some of us chose to make it, some chose not to. Some offshored, some simply ignored. I would say that in that scenario specifically, we're sitting a year later from when the FinCEN guidance was issued. We knew what that guidance was. Had there been the enforcement aspect, I don't think we'd be sitting where we are today.
For us, I mean, we onboard all of our merchants the same way. It is a check-the-box compliance type of scenario. It's after that, when they start doing transactions, that we then take a risk-based approach and look at, velocity of transactions, average sales price relative to the industries that they're in, those kinds of things, and flag them for suspicious activity. We've caught some bad actors with those types of risk measures, and we've actually kept merchants from coming on board in some instances as well through the practices that we use. So both the compliance and I think the risk-based approach are working well for us.
And I think in front of you, you have some of the best-in-class businesses that have actually actionably implemented these compliance programs. A compliance program is just a stack of papers, essentially, if you're not actionably following up transaction monitoring, customer archetyping, and doing your due diligence at every level.
And I think there's still facts to come out about Mt. Gox. We transacted with them early on when it became clear that they could not get money out of Japan. We knew there was a big problem, and we stopped dealing with them completely. We took them out of our Bitcoin NAV index quite soon after we launched the trust. I don't know whether or not all of the Bitcoin was stolen. We thought it probably felt more like a lack of internal controls. They found passwords that got them access back to 200,000 Bitcoin, I believe. The idea of being able to hack that many Bitcoin out of a cold storage situation doesn't seem like it rings true to a lot of my technology colleagues. So I think there's still a lot to learn there. But I think, as a general matter, they lacked regulation oversight in Japan. All of the people today that you're talking to work for regulated businesses. We are broker-dealers, we're MSBs, we're money transmitters. So we're already subject to examination. Our trust is audited by E&Y, so we wanted to have very robust processes, procedures around Bitcoin storage so that our investors feel comfortable that if they give us their money and they hold something representing Bitcoin, that Bitcoin is safe and will be examined by FINRA and other regulators in the course of the next year. So I think that the processes are already there for you to have those examinations, to make those examinations, and you'll develop new processes and procedures as you see fit. But I don't think Mt. Gox is really representative of how most of the market's operating.
Just want to follow up on Mr. Behrens. You said that the folks at the table representing basically the best in class. And so my question is, so how do we as do we as regulators need new tools in this space to determine whether or not you or your competitors are in fact acting, best in class, whether you do have the internal controls? In other words, do we have the tools today to do that, or is there something inherently different that requires us to acquire or develop new tools?
I do think that there are some unique attributes with the ledger system, with the public ledger system, where you can perform audits on solvency within institutions. I also believe that many of our companies have been proactive in asking for guidance from the regulatory bodies and crafting those controls at inception. And that's been a strong suit of our organization, is that partnership and understanding the concerns from the outset and building our processes around that.
luxury of being audited by one of you. And I mean that sincerely, though. It was a very good experience. It was very insightful, and it made us a better organization. There were some gaps. So when you state, what can we do to be able to look at that framework, or how can we improve upon the rules that are enforced upon us? We had this 5-hour audit, and it wasn't until the 4th hour of it that the last hour was spent specifically going through the general ledger and talking about the gaps. I don't know if other companies are as transparent as we are, but we understand what those gaps are and where the system needs to meet up with them. In doing so, it was a very educational process. I would like to think that in a year from now, we're not educating, but we're in fact looking at the system, monitoring the system, and enforcing the system that already resides. And I would say that last leg of the audit was the one that was probably the one that concerned me the most on my mind, in the fact that I don't have all the answers, the states don't have all the answers, but there's a clear gap between the two of us as to how we overcome the challenge of looking at the public ledger and matching the two up. How do we reconcile something that's not residing in that U.S. bank account? How do we reconcile that trust level of what I'm holding or say I'm holding for my consumer versus what I actually hold? That's just a very simplistic example, but I would say the educational aspect of what we do, maybe educating the states over that hurdle.
One thing that I wanted to talk about today was a bit about, an obstacle that we have in the ecosystem today, and that is, the ability to be banked. It's very difficult for Bitcoin industry companies to get a banking relationship, and only being completely transparent with your compliance officer at the bank, providing, endless data on every one of our merchants, whether they're transacting or not, is the only way this works. And I'm happy to provide that, but at some point, banks are just backing away, saying the cost to do this to them is just too burdensome, and they just will say no. And there's money to be made here for the banks. So I'm not absolutely clear on the level of scrutiny that they're having to go through when they do an audit with the FDIC or the OCC, but I'm being educated by my bank's compliance officer, and we will continue to hand over everything and anything that they need, and it's been educational as well as, Megan said, on understanding what is required of them, so that therefore I'm requiring it of our merchants. So only through that kind of two-way feedback is this working, but I think that's a good step that the banks are taking. But I wish there were more, accommodating.
I would concur. I had a very insightful meeting, and Kevin was a part of it with the FDIC, and we've actually been turned down by about 61 banks now. That's overwhelming. We never get to the word cryptocurrency. We state the word MSB, and the conversation halts. So I wouldn't say that it's specific to this panel that you see before you today. I think it stems specifically to us being put into a category of high risk. But in this meeting, what was fascinating was the fact that when I talk about the transaction flow that we could potentially have, the sheer volume of what would go through, when you think about how exchanges operate, whether it's the CME, ICE, NYMEX, NADEX, you name it, there is a tremendous amount of volume that surpasses through that exchange the connection of a buyer and a seller. A community bank is typically not equipped to be able to handle that level of transaction volume, nor do they have the insight into my business to know how to gather enough information at the KYC process to know who we're touching and what we're doing. There needs to be a bridge between where we are as an MSB in a high-risk category and where the banks are and how they're being regulated to be able to facilitate better communication between the two.
And I would note that a bank, a large bank that we've had a relationship with for over 8 years, gave us notice yesterday they wanted to end that banking relationship, in part because our transactions around Bitcoin, even though we're not an MSB or an exchange, raised our risk profile to a place where it was too much work for them to figure it out. And that was really, really discouraging.
I go back to Mr. Syracuse?
A question for Mr. Barron. I'm curious about the storage of Bitcoin and whether or not you see in the future sort of the protocols surrounding storage of Bitcoin and other virtual currencies will become standardized and what that will look like.
Obviously, the ecosystem is evolving. What we've done in our company, Zappo, is we've created physical layers of security, technological layers of security and segregation, as well as basing our vaults in jurisdictions around the globe, that we have a certain amount of comfort with their policies. The storage and security is ultimately going to be the hindrance or what's going to thrust our industry forward. Having a safe form of retaining and storing that value, just like any traditional financial institution, is paramount to their success. We add an additional layer, which is ensuring the deposits in a Bitcoin-denominated insurance, so our deposits actually are able to scale along with the price fluctuations as well. I think there are unique attributes with things such as multi-signature technology, which many of you are probably familiar with. And by leveraging these technologies, we can create a greater comfort for the consumer and ultimately affect better consumer protection.
I was going to echo the multi-sig. I think that's going to be a big development in securing Bitcoin. Are you familiar with the concept? Okay. Also the addition of escrow services for some types of transactions is something else that could be done over the Bitcoin network.
Commissioner Hagler?
Thank you. Brian, you asked the last question I had geared up already regarding the challenges that MSBs have with finding banking services. As kind of a tag along to that question, have any of you explored or worked with banks in terms of becoming just an outright partner with them as they, or have they expressed an interest in doing something in the virtual currency space?
Yeah, I mean, it is absolutely a partnership. It wouldn't work any other way. So we would help if they wanted offset some of that cost if we needed to help them, add another compliance person or whatever the cost that they're incurring. I know that they are. Our bank is doing an OFAC check as we are when we onboard them, but they're also doing a bit of website scrubbing and digging their own on some of the merchants that are doing some of the more larger transactions. I mean, it's unfortunate that there's no exchange here in the U.S. and that's up and running, and there's a reason for that. And we've got to remove those obstacles, or they're going to go offshore. And I think that in the U.S. we want that governance to to remain here in the States. So we can figure it out.
And we've been very successful coming from a compliance background and being in the ACAMS community. Many of the compliance officers at partnered banks, we've had an ongoing dialogue and really reaching out and educating them on how to mitigate the risks in regards to AML and fraud. And I feel through continued work in the compliance community that we can come to an understanding about the unique attributes, the unique risks, and their unique advantages with our technology.
I believe I heard the question a little differently. Correct me if I'm wrong. I heard, do banks want to partner with us to extend perhaps that innovation to their clients?
Yes.
So my response would be yes. There have been two banks in particular. There was one in New York, and there's one in Georgia. And once we did a demo of the system and of the platform and the exchange in particular, they were fascinated as to how can we extend this to our consumers? What can we do to extend this attribute out to the public? They actually explored it, and I think they did a good job of exploring it. But I think ultimately, this was in September of last year. They came up against a roadblock that, because of the risk profile, it would put additional scrutiny that they would not be able to handle within their organization to to be able to proceed forward.
As a broker-dealer, we're not looking to partner with other
And I
banks.
apologize for not asking better questions.
That's
for you
okay.
at the table.
Commissioner Breakspear, do you have another question?
I have a slight, you talked about being a broker-dealer and obviously having investors, and yet the other three members of the panel are more focused as money transmitters, which leads to the question if you obviously think this is some form of security you're dealing with, and the others think that it's some form of money. Would you like to elucidate on that?
If I gave you that impression, that's not at all what I was trying to say. We have a broker-dealer subsidiary, and we have an asset management subsidiary that created an investment vehicle that's issuing shares. Those shares are 100% a security, but they're investing in Bitcoin. So it's almost like a gold ETF or a commodity ETF. The investors do not actually get access to Bitcoin, they only get access to shares. So it's 100% a security, 100% being sold pursuant to an SEC exemption from registration, 506C. And our broker-dealer is acting as a market maker, trying to find people who are willing to invest in that security offering. But that's, I believe, as I said to, Dana, in my mind, there's no indicia of Bitcoin that should make it be deemed to be a security. I know that there's been some analysis, I believe in Texas, the court there in a Ponzi scheme situation, a decision was made that Bitcoin is not a security. And I think where people get caught up and where some confusion happens is you do have a population of people who are investing in Bitcoin as an asset investment opportunity, the way they might buy gold or they may buy another foreign currency. So it has investment aspects, but it is definitely not a security in my mind.
I should have been clearer. You know, it's an investment in something, and if it's gold, gold to me is a commodity, it is not a security. And I think the implication is, what you're saying is it's an investment in a commodity.
I think, I said earlier, I believe that I think that Bitcoin should be treated like a currency. There are definitely currency ETFs, there are definitely mixed currency ETFs. I think, in my mind, it has all the indicia of a currency, not a commodity. It's not a derivative. There's no derivatives existing on Bitcoin right now. Should that happen, then yes, those would be derivatives. But right now, in my mind, Bitcoin is a currency type, a virtual currency. That's exactly why it's called cryptocurrency, because it acts just like a currency, not as a commodity and definitely not like a security.
And I'm not trying to challenge you totally, but
But go
thank
ahead,
you
you
for
can
the
do it again.
clarification. But does it not act more like a commodity in terms of its level of volatility than a currency?
I believe the reason for the volatility is exactly what we've been talking about, the lack of a deep pool exchange in the United States. Once that happens and volatility becomes more limited, then I think it will look more like a typical foreign currency. And if you look at jurisdictions around the world, and I think this is something we have to be very mindful of, most foreign jurisdictions are coming out with a decision that they're going to treat cryptocurrencies as a foreign currency or some type of a currency. To my knowledge, not one other jurisdiction has made a determination that Bitcoin is a security or a commodity. I know many jurisdictions are still making that analysis, but I think we have to be very careful to be mindful of how Bitcoin's being treated around the world for exactly what we've been saying. If the U.S. regulatory scheme around Bitcoin becomes significantly different than other jurisdictions, there's a real risk that the business will shift offshore because it's an international digital currency. It's not a U.S.-based digital currency.
Commissioner Breakspear, I'd also add that, absent of options and derivatives, we're going to see that volatility, but once those come into play and we are able to hedge downside risk, the market will level out.
Commissioner Gonzalez?
Thank you, Mr. Chairman. Financial institutions certainly are economic engines for all of our states. Look down the road, if virtual currencies become of widespread use, then what do you see as far as market efficiencies coming out of that?
the concept of real-time payments is very compelling. You're able to send money to your manufacturer in China instantaneously, and that your product is now shipping immediately, I think is very valuable. It's never been duplicated before, and in this Bitcoin ecosystem, it's possible now at almost no cost. At BitPay, we're obviously a merchant acquirer, but we're looking to extend that to up the supply chain to our merchants' supply chain and get them on board so that they're conducting payments to their suppliers in a seamless, instant manner. Yeah.
And the unique attributes of the technology, having a decentralized system that doesn't rely on a central intermediary to ensure that the transaction has occurred. It's one of the unique attributes of Bitcoin that, without having any need for a financial institution to vet the onboarding process of the party and solving other issues such as the double spend, ensuring that the transaction has occurred, it's gone from one party to the other, and that no other party has received or sent those funds.
I think I alluded to the benefits of the market efficiencies in my opening remarks, but the speed of the transaction, the transparency of the transaction, the security, one of my favorites. And then the ability to change the dynamic of what it does for micropayments more significantly and those who are underbanked. If you look at the fee structures of the traditional models that are out there today, it's enormous. That one attribute of the fee schedule itself, being able to change that dynamic to not necessarily reward, but give them a level playing field rather than punishing them, is pretty phenomenal.
I would just agree. I think all the points that are really relevant and important have been made, but you do see phenomenal opportunity for immediate payment, low-cost payment. And if you think about it outside of the United States, again, this is an international concept, not a U.S. concept. How much money will be in the hands of consumers if you're not having to go through Western Union and pay 9%, 10% of what you're sending home, and instead you're getting 99% of what you're getting home. There's a lot more money that goes into the hands of consumers in a secure, immediate, and I think, pretty regulated way.
Commissioner Leary?
I have no further questions.
Thank you. Commissioner Cooper? Well, I want to thank each of you for your comments. This has been insightful, I think, for all of us. We gave the opportunity for anyone who did not have an opportunity to present today, if they wanted to sort of take part in an open mic. Nobody signed up, but if there is anyone here who would like to have their say, you are welcome. We'd love to take, and in doing so, I ask one thing first, or a couple things. If we could have your name, your affiliation, and if you could just limit your comments to a couple of minutes, we'd appreciate that. And we've got a microphone right here, and we're going to bring a microphone right up front here. So just come right up to the mic, and please, as I said, give us your name and affiliation.
Steve Sunderland. I'm with QuickCoin, a virtual currency business in New York. We are not operating. We shut down in March of 2013 until we get some more regulatory clarity. I have a lot of points here, so I'm going to try to pick just one. First of all, the guidance was excellent. A fool and his money is soon parted, and you can give them all the advice that you want, and unfortunately there seems to be I don't want to say a lot of fools in Bitcoin, but some people knew the writing was on the wall that Mt. Gox was going to go under. Somebody asked a question about whether you could figure out if they were solvent. Absolutely. At one point, you could pass money between addresses. You could sign a signature, cryptographic signature, with the address containing that money. So somebody, if there was some regulation, could have been in place to prove that those funds existed. And I think the bottom line is just the consequences. We are only now seeing consequences of this action. For the past 4 years, there was a lot of nefarious activity going on because there were no consequences. And I think now that we're starting to, we've reached this point where we're getting this kind, I mean, and the panel, and I think I want to thank you guys for bringing this. So that was it. Thank you. Thank you, though. This is it's very important. This is a moment in time where we are seeing payments transition greatly, and I just think this is a great opportunity to move forward with some great regulation. Thank you.
Thank you.
Thank you very much. Does anyone else have any comments that they'd like to add? Okay, so I want to, again, thank this panel, thank all the other panels that we had today. This was the first hearing of the CSBS Emerging Payments Task Force. We will be scheduling future hearings to hear different perspectives on payments issues and payments trends, and we will be having deliverables over the course of the year. So we thank you for your input and look forward to working with you in the future. Thank you.